the theme is still patience, and the Fed just wants to see more data to make sure that inflation is convincingly moving lower.
There's no clear indication that they're going to need to rush into cuts.
They're trying to tell us that they're keeping all optionality open. Even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate-cutting cycle.
It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad.
This is Bloomberg Surveillance with Jonathan Ferrell, Lisa Abramowitz, and Anne-Marie Hordern.
It's our favorite time of the week. Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now with equity futures down about 0.5% on the S&P 500. We have had a record-breaking week. 4 consecutive all-time highs on the S&P 500. Can we make it 5 for 5? Let's go through the week. CPI, downside surprise. PPI, downside surprise. Jobless claims, the wrong kind of upside surprise. If you took a step back and looked at the equity market this week, you'd have no idea that very confused Federal Reserve meeting even took place.
Because what's going on is the same thing that's been going on all year. The macro-related stocks kind of wavering around, but the AI driver is just powering ahead. And so when you look at the index level and you see a 29th record high this year, yet another one, you have to wonder, is this reflecting broad strength or is this just reflecting the dominance of U.S. tech?
We've had quite a move in the bond market too. Double-digit moves across the curve, the 2-year and the 10-year, something like 20 basis points plus on a 2-year and a 10-year. The 10-year this morning down 4 to 420. The 2-year down 2 to about 467. And some news coming out of Washington, D.C. that we need to talk about throughout the programme. Let's start with this. The former president, Donald Trump, on Capitol Hill yesterday, reportedly promising to cut the corporate tax rate to 20% from 21%, vowing to make the 2017 tax cuts permanent. We know that. We've already heard he wants to exempt tips from federal taxes as well. He's going to promise to slash regulations, as you might expect. How's he going to pay for this? This is a story we came up with in the last 24 hours. According to people familiar with the matter, he floated the idea of using tariffs and the revenue that you get from that to offset some of the tax cuts they're going to make permanent maybe next year.
And even get rid of the income tax in the process. I mean, basically, this is going to be an all-tariff-funded kind of deal. I kept thinking to myself, Adam Posen, come on over. Let's hear what you have to say, whether that's feasible, what that does to trade, what that does to revenues, what that does to a national dominance in certain industries. A lot of questions here about the details of this. I'm very curious to hear what some of those CEOs had to say, because they've come out and talked about the importance of global trade and the importance of recognizing our global trade partners. Well, do they say to him, that sounds great, Mr. Former President? Or did they say, maybe rethink that a little bit? It might not work as cleanly as you think.
My guess is I would say I'd love that 20. I'm not sure about those tariffs.
Yeah.
So I imagine behind the scenes, it's like, yes, give us that 20. And then sort of on the record, it's like, we need to make sure that we still work with our global trade partners, obviously.
It's difficult right now to understand exactly what the dynamic is like in that meeting. Because as you said yesterday, and I think it was a really astute point, these are pragmatic leaders. They are ostensibly the diplomats, the new diplomats of the United States. They go to different countries and they want to do business across borders. So how do they deal with highly protectionist policies? And what was said in that meeting, how similar was it to what was said verbally in a way to try to assuage worries about the debt, but not actually answer a lot of questions?
How business-friendly is this Republican Party going to be under a second term of Donald Trump if he wins in November? It's going to be a big part of the discussion for the next year or so. For the next month or so, we need to be talking about French politics as well. So the latest news on that front is the parties on the left are coming together to form a little bit of an alliance. The Finance Minister, Bruno Le Maire, with quite a big warning about the left-wing alliance. If they do win, it would mean an EU exit could be on the table, which is kind of bizarre. We've got the euro down 0.5%. The CAC 40 has erased all of the gains for 2024. If you look at SocGen, we're down by more than 15%, not year to date, week to date. French banks have been absolutely hammered so far this week. So
did you think that that was because of this proposal to possibly leave the EU, or did you think maybe it was because no party is going to get the debt under control in France? The country has already been downgraded once. And you have this idea that not only did Emmanuel Macron have an unforced error, according to a lot of people, to call a snap election. But if the left is coalescing around a couple of candidates and you have the right coalescing around a number of candidates, guess which party loses? That's right, Emmanuel Macron. And so people are looking at this and saying, OK, he blew it because he's going to get what he didn't really want. He thought that everyone would coalesce around him. That was my impression from some of the market action.
So the FX market is a relative gain. If you look at stocks higher on the week in the US, you look at bond yields lower on the week in the United States, you might think the dollar was weaker off the back of all of this. The dollar's stronger on the week because the other side of the trade is dreadful, and that's the euro. It's been a difficult week.
Just to put this into cold relief, and I think you're absolutely right to show this divergence, because the EU-US divergence is shocking this week. What you're seeing is a 1.3% gain or 1.6% gain on the S&P 500 week to date. What you see is basically a 1.4% decline on the stock 600. This would be the widest divergence going back to March of last year during all of the banking turmoil. This is market. And it highlights, A, a real lack of risk appetite beyond the big tech, but also, B, American exceptionalism, all the people calling the death of it, maybe a little soon.
Back on the table. Last week, euro dollar 109 this morning, 106.80 on that currency pair. Equity futures, session lows at the moment. I'll bring you the scores on the S&P 500, down about 0.6%. We've been spoiled all week, 4 days of gains. Looking at a morning of losses on the S&P 500, there's your move in yield to lower by 3 basis points on the 10-year. 420.93. Coming up this hour, we'll catch up with Geoffrey Yu of BNY as US equities continue to break records. We'll speak to Bloomberg's Natarajan as Donald Trump pitches more tax cuts, and Pooja Sriram of Barclays saying the Fed will be on hold until December. We'll begin with our top story. The S&P 500 looking for 5 straight record-breaking sessions. Geoffrey Yu of BNY Mellon saying this: the market is now, as it was when rates were rising, more dovish than the Fed. We still see a rate cut in September, although recognise the need for greater confidence. Geoff joins us now for more. Geoff, let's sort of step back and refresh and get your big takeaway on the week so far. Tons of data, lots of Fed speak. What stood out for you?
Well, what stood out for me is how many people are actually now looking at the OAT bund spread and seeing, going back into history, how high that could go. So, if the scenarios are along the lines of, what some French politicians are talking about, then that could go a lot wider as well. And let me tell you, looking at our flow data, our custodial flow data in fixed income, there is a big OAT position out there that can continue to unwind. That is my concern right now.
Geoff, when you listen to the French politicians, which ones? Because clearly Bruno Le Maire, the finance minister, is trying to scare people into voting a certain way. Who are you listening to?
Well, I'm listening to both sides right now. I think one thing that markets are, well, at least the bond market, the Eurozone bond market, is catching up on the fact that it doesn't really matter in terms of if it's a left coalition or right coalition. The fiscal policies are worrying. So the comparisons, and maybe this is a thing in the UK, right, some schadenfreude here, but drawing comparisons between what could happen in France versus the mini budget crisis in the UK in 2022. I've heard a lot of questions from clients about that as well. Those are the scenarios that people are talking about. So beyond the headlines, let's have a look at the policies. Is anyone proposing some degree of fiscal consolidation right now? And it doesn't sound like it. That's the concern for all assets.
Geoff, when you dust off some of the history books and take a look at how wide that spread could get between OATs and German bunds, what's your big concern here? Is there a systemic risk or some kind of broader contagion, or is it just simply that it highlights the fragility of a region that still has some distress left over?
So I would say still some distress left over, this suboptimality of the euro as a currency and the Eurozone as a currency union. So those old arguments from 12 years ago, they are being dredged back right now, so to speak. We're not looking at very, very bad scenarios or anything like that. And let's be clear, the ECB has so many more facilities, all those acronyms. I think OMT is going to be mentioned very, very soon as well. Signore Draghi is going to be in demand too. But it does highlight some of the structural issues, which I think the Eurozone policymakers really need to start to address right now, because the time scale is limited. And bearing in mind, 2027, next round of presidential elections, we'll be looking at new budgetary negotiations in the European Union as well.
So I'm going to say it for you, Geoff. You said, reminiscent of things that happened in the UK. We've been calling it a Liz Truss moment. We're wondering how much we could possibly see market disruptions from unpredictable political events that are very much likely for the rest of the year, not just in Europe, but also the United States.
Well, I would say on the US's side, what you mentioned at the top of the hour at the beginning of the programme, the next administration, how are they going to fund, certain fiscal commitments? That is very much, what we are focused on right now. Again, looking at our flows, especially the cross-border, the international investor community, are they going to continue to buy US treasuries? Is a fiscal premium going to be demanded there? That will come into play. But I will say, though, if the market needs to worry about Europe and the US at the same time, the US will still be a safe haven, no doubt about that.
Geoff, can you just explain to me then how you take take positions in fixed income when we have all these risks around the sovereign in places like Europe and potentially here in the United States on the horizon as well?
Well, right now, I wouldn't worry about the front end, but I think, steepening across the board, that is going to be a concern. And let's bear in mind, last week, all the talk was of this supposed hawkish cut by the ECB, right? So that means, long-term bond yields, they were going to move up anyway, and in real terms, cost Eurozone governments in terms of financing their liabilities. So those pressures are still going to rise, and given the amount of build-up there, not just in the French government debt market, but also in the US debt market. So I think the pressure on yields back end of the curve is still going to be to the upside.
There's a larger takeaway right now, which is why are bonds rallying? Why are yields lower? Is it because of central bank easing, or is it because of a whiff of some fear of this flight to haven kind of trade that's keeping this equity rally from broadening out more materially? How much do you sniff out some potential fear or weakness or hiding out in havens rather than something broader that's fueled by the rate cutting cycle that a lot of people are expecting?
So here we need to really explicitly define what is a haven. So bonds will be considered havens within the Eurozone. US Treasuries on a global basis will be defined as havens as well. I'm looking at Swiss francs. So started off as a funding currency beginning of the year, and then the SNB cut rates in March. Now, according to our flows, being bought back very, very aggressively. And I think we might get a quasi-hawkish cut by the SNB next week as well. So I still like Swiss franc as one of those currencies. Ticks the haven box as well. Yen, how is that going to behave? Very undervalued, but can be a haven in environments like this as well. So yes, the market is going to search havens, but also can make is US tech a haven in this environment? How does European politics affect US tech innovation? Probably not much. So you could argue, would it really affect US equity markets, especially in that space? Probably not as much as in the past. So those correlations could break down as well. Interesting.
Jeff, wonderfully get your perspective, sir, out of Europe. Jeff Yu there, if BNY Mellon. If you look at the French-German spread at the moment on a 10-year maturity, we've gapped out to about 75 basis points. So the wider the year, the wide's also the widest level going all the way back to 2017, which is when, of course, we had that Macron-Le Pen presidential race. If you go all the way back to 2012, you're looking at something closer to 200 basis points. So this is the political stress of 2017 on the table at the moment. Could change, could get worse, could get better. It's certainly not the economic, financial stress of where we were more than a decade ago.
Which is the reason why Jeff was saying, I look at the history and I say, well, it could go a lot further. Here's the issue. How much would that fly in the face of the ongoing consolidation of the European Union, the bringing together of some of these nations, and how much does this really just underscore that there is no alternative to the dollar, even at a time where a lot of people are saying, maybe it'll weaken in response to some of these fiscal pressures?
It makes that G7 meeting down in the south of Italy feel all the more bizarre. When things like this are happening around the world right now, and we're not really talking about them at the G7 level, we're focused on tapping Russian assets, helping the global south, all things that are really important and warrant significant conversation. But when you think about what's on the top of the pile for priorities worldwide for electorates in the United States, what's happening domestically for people like Macron right now, that hasn't been part of the conversation at all between global leaders, at least not publicly.
No, and I was reading one article that was kind of wonderful about how Rishi Sunak was supposed to be the lamest duck of all. And then Emmanuel Macron said, hold my beer. And in the meantime, Giorgia Meloni is basically taking selfies and laughing and holding court as it is her G7.
She's pouring the drinks for everyone.
She's like, listen, you know what? When you're ready, come around and we can have a conversation. Other than that, just keep flailing.
AMH is going to join us in about 5 minutes' time. Look out for that conversation. Let's get you up to speed on news elsewhere this morning with your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. As you mentioned earlier, Donald Trump told U.S. CEOs that he will cut the corporate tax rate to 20% if he wins a second term. That, according to people familiar with his remarks. The former president met in Washington with around 100 CEOs, including J.P. Morgan's Jamie Dimon and Apple's Tim Cook. The current corporate tax rate is 21%, and even a small reduction represents a tax cut worth billions of dollars each year for profitable U.S. companies. A check on Adobe shares for you this morning, up nearly 15% in the pre-market trade. They projected a strong sale for its suite of creative products, and it suggests that customers are adopting Adobe's new AI-based tools. Adobe has been integrating AI into some of its most popular products, including Photoshop, which the CEO said is helping the company attract a, quote, expanding universe of users. Meme stock investor Keith Gill, a.k.a. Roaring Kitty, appears to have exited his entire options position in GameStop. A screenshot on his Reddit showed that his portfolio no longer include the 120,000 call options that were set to expire next week. Now, at the same time, his screenshot also showed that he added to his heap of common shares. All of that happening on the same day that GameStop had to delay their shareholder meeting because they had technical difficulties with their live stream. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, the G7 facing a world of unrest.
The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war.
Anne-Marie on the ground, live from the G7, up next, alongside the World Bank president, a conversation you don't want to miss. Live from New York City this morning. Good morning. Session lows this morning in the equity market. On the S&P 500, we're down by 0.5%, pulling back from all-time highs. Yields are lower too, by another 3 or 4 basis points on a 10-year. 420.74, a 20 basis point move lower over the week so far. Quite a move, quite a move. Under surveillance this morning, the G7 facing a world of unrest.
The agreement that President Zelensky and I just signed also lays out our shared vision for a just peace, a peace rooted in the UN Charter and the principles of sovereignty and territorial integrity, a peace with a broad base of support around the world that holds Russia accountable for the damage it has done in this war.
So here's the latest this morning. World leaders continuing discussions in Italy today, looking to boost investment to the global south and ease migration in Europe and the United States. The talks coming after the G7 came to an agreement on providing aid to Ukraine by tapping frozen Russian assets. Joining us now live from Italy is Anne-Marie, alongside the World Bank president, Ajay Banga. AMH, good morning to you.
Good morning, John. That's right. What we saw yesterday is a boost from private investment from the likes of Larry Frank of BlackRock. He was here at the G7. And what these private investment funds are trying to do is boost money going to the global south, middle income countries. And part of this is made possible by programs at the World Bank. And I'm pleased to be joined by Ajay Banga. Thank you so much for joining us. John there was talking about a big emphasis, especially on Africa. This is to try, one, to counter China from the U.S. point of view, but also European leaders are trying to stem the flow of migration. How are you seeing this public-private partnership play out?
Yes, I think Africa, the real situation is that Africa is going to be 1.5 billion people going to 2. And frankly, how can you not have a continent of that type contributing to future economic growth? That's the other way of looking at why Africa. And so what I'm trying to talk about there is what creates jobs for those young people. It's got a demographic dividend coming through it. But if you don't give them clean air, clean water, healthcare and education when they're growing up, and jobs when they're older, you have a problem with that demographic dividend becoming a liability. Can't do that only with government money and multilateral money. That's why people like what Larry did yesterday or Satya was talking about. These are all the ways to get private sector money as well, to come in at scale, to help create the jobs in that continent.
How difficult are these conversations on the sideline of the G7 when you see leaders here coming up wounded by recent elections, battered, because what their electorate is focused on is rising prices at home and immigration coming into their country. And meanwhile, you have leaders talking about investments in other parts of the world and also what's going on, of course, with the war in Ukraine.
Yeah, but remember, if you're discussing private sector investing, this is actually good for these leaders because it's a way to enhance every dollar that governments and multilateral institutions put in to add a little more. And that's very, very helpful to them. So it just depends how you approach this discussion. My way of approaching it is it's not all about the money you give one-on-one bilaterally. It's about the leverage you get. So, for example, if you give the World Bank money into what we call IDA, which is the institution that provides grants and concessional financing to the poorer countries, a lot of which are currently in Africa, unfortunately, that gets the leverage. Every dollar you give me as a country, as capital, I can make it 4 times. So leaders know that too. And then if you bring in the private sector, that 4 can become 8 and 10. So people are thinking about how to get a dollar to go to 10, not just a dollar for a dollar. And I think that makes for a good conversation.
But is multilateralism harder, which I know you're a big believer in, when you see the rise of nationalism?
Oh, yeah, sure. Listen, I've been saying for years when I was in my old job in the private sector that one of the biggest things that worries me is chauvinistic nationalism, because it tends to create the absence of connectivity. But I think if you look at the last few months itself, we've managed to get capital and hybrid capital and portfolio guarantees into our institution, and we are the one that's working with this multilateralism. So let me give you an example. People keep asking me about the debt crisis in Africa, right? And if you think about the 4 countries from Africa that entered the G20 common framework, Zambia, Chad, Ethiopia, and Ghana, from the time they entered, we in the bank have given them $16 billion of money. Nobody else has given them money. Of that 16, 8 was concessional and 8 was pure grants. Of that 16, 9 was net positive. So that's all multilateralism at work. People just talk about one part of it, but multilateralism does work with the leverage that institutions like the bank provide.
We, of course, have a U.S. election coming up. And part of what you've wanted to expand in your approach to the World Bank is not just poverty, but also climate. Do you think that would be at risk if we were to see a Trump presidency?
Not really. I just remember that during his prior presidency, he was one of those who actually gave the capital increase to the World Bank. He sees the value of this leverage and the value of this kind of institution. Just to be clear, when I talked about a livable planet, I want to make sure it's not just climate. It's fragility, conflict, violence. It's things like pandemics and healthcare. Because the whole idea of livable planet allows you to expand the aperture depending on what's relevant in that country, that region. In some cases, it is climate. In some cases, it's fragility, conflict that is driving things. In others, it is climate that is driving the fragility and conflict. You have to get to the root cause and try and go at it.
Will there be more pressure, you think, whether or not it's Trump or Biden, potentially to figure out what's going on with China? They are the biggest bilateral creditor, and many say that what they are doing in a lot of these countries is called a debt trap.
Yeah, interesting. So I think where they are today is quite different from what it probably was some years ago. All the conversations we've had, the G20 Common Framework and the IMF and the World Bank run something called this Global Debt Sustainability Roundtable. And in that, everybody comes. The multilateral who are there, us, the bilateral creditors, the private sector creditors, of which there is a very large amount, and then the so-called earlier ones, the Paris Club. What's really changed is it's not just bilateral credit that's an issue, it's also the private sector that is involved in lending. So today, if you want to do a debt restructuring for these countries, you have to first know who's put what money on the table, what's it cost, what's the covenants of its repayment, what's the whole thing in it. Get that data on a sheet. Without that, it's very hard to know how to adjust that money in. So that took time. But as you see it getting done and you can begin to see countries moving through the framework, I still think it's too slow. I think it should be faster, because if you make it faster, more countries will feel emboldened to enter into the framework. And I think we need to work our way through this.
What you're offering, do you see as a viable path for these countries instead of, say, turning to China?
Oh, yes. I think it's not an either-or. By just China. People are borrowing money from India. They're borrowing money from the United States. They're borrowing money from the UK. Remember this, bilateral creditors have been around for a long time. It may be called ODA in some cases. It may be actual lending through some countries. There are countries borrowing bilaterally as well. I don't think it's an either-or, that it has to be either multilateral or bilateral. I just think it has to be done in a fair way, a transparent way, in a way that we can all understand what's going on, and then do it in a way that the countries who are borrowing also don't use only the borrowing as the resource, but also spend efforts on domestic resource mobilization, doing other things that enable them to free up the resources to do the right thing with development.
Ajay Banga, thank you so much for your time. John, that was the World Bank President, Ajay Banga, on the sidelines here of the G7. He's part of a lot of these discussions when it comes to investment in the global south, John, and those developing and middle-income countries.
MA's great work, as always. Anne-Marie on the ground in Italy. We'll catch up with Anne-Marie a little bit later this morning. A phrase I've used a million times already this week, squaring the circle. Federal Reserve trying to square the circle. G7 trying to square the circle. Anne-Marie had a decent go at it just then.
Yeah, trying to figure out exactly how we deal with the fact that a lot of these countries are becoming increasingly nationalist. You can call it whatever you want. He called it chauvinistic nationalism.
I've never heard that before.
I've never heard that either. I wrote it down. I looked up the actual definition of chauvinistic to try to understand. I knew what it meant, but you know what I'm saying. Like, what does the actual sort of nuances of it mean? I'm still a little befuddled.
Is Le Pen a chauvinist? I'd never heard that phrase before.
Is it the idea of just national superiority? Does it have a male-female connotation?
Don't know. We'll ask him one day.
We'll ask him.
I'm trying to figure that out. From New York City this morning, beautiful morning. Good morning to you. Four-day winning streak on the S&P. Can we make it day 5? This morning's a struggle. We're negative by 0.6% on the S&P 500. Quite a run so far, though. Record highs every single day this week. Monday, Tuesday, Wednesday, Thursday. On the Nasdaq, we're down about 1/3%. On the Russell, the small caps down by 1.4. We said on the day of the Fed, they had a day. Was it anything more than a day? We'll find out. The small caps suffering this morning, Bramo.
I have to say, the fact that they've been suffering is really interesting to me because every gain that you've seen, the 29th record high that we got yesterday, was kind of a tired one. Under the hood, a lot of the stocks not participating, equal weight, small caps. You just wonder whether this is people sniffing out weakness in a flight to havens or whether this is actually an immaculate disinflation that they're really rallying around.
We were looking for 5 days of gains in the equity market on the S&P 500. We're getting 5 days of gains in the bond market. The two-year yield is dropping once again. We're down by 2 basis points to 467. We're in the 420s, and just about to drop to 419 at 420.93 on a 10-year. We're down 3 basis points. This is a move of more than 20 basis points over the week so far. And there's a lot of data behind it as well, from CPI to PPI to jobless claims as well.
Basically, when you take a look at the flows, it follows this. People are looking out and saying, now is the time to lock in duration. You can see the flows into medium and long-term bond funds outpacing those in short-term funds by something like 9-1 as people try to get in on what they see as the beginning of some sort of shift in the trend. Question I have is, what does that mean for the rest of the economy? Is this still the immaculate disinflation, or was the jobs report yesterday, or the jobless claims, really a shot across the bow? This isn't going to be just an easy kind of wonderful panacea that a lot of people would like.
So claims at 9-month highs. The problem with claims is that we've had a little bit of a head fake a couple of times over the last 9 months, and then they've come back down again. But I'm with you. That is always the concern, that the Fed is caught offsides. And this is what Neil Dutta of Renmark's been talking about now for a while.
Look, I don't want to be subject to narrative ping pong, although I've been doing it for the better part of the past 12 months. But I am curious about how much this starts to actually gain speed, where you start to get ongoing highs, but the air is getting really thin up here. You have Broadcom leading the rally. You have others leading the rally, Adobe. This is not a rally driven by consumer cyclicals in the sense that suddenly the economy is going to be rip-roaring ahead.
Give yourself some credit. You're pretty consistent. Sort of like
bearish.
Doom.
Bearish.
And that's it. Pretty consistent.
Thanks.
I want to turn to the FX market. Push this through the FX market, you might expect a weaker dollar. That's not what we've had this week. We've had a stronger one, a weaker euro. This has been about the single currency. Last Thursday through 109. This morning, just about holding on to 106 at one point. 106.88 is where we are on the screen right now, and this is why. Under surveillance this morning, French President Emmanuel Macron suffering another political blow. Parties to Macron's left vowing to unite in a bid to challenge him and Conservative leader Marine Le Pen. Macron is calling a 2-round election for June 30th and July 7th. And the French Finance Minister Bruno Le Maire is warning that if they're successful, run the path towards leaving the EU.
It's sort of curious timing that they have this sort of fiery rhetoric and the potential to leave the EU just weeks before the annual meeting of the North Atlantic Treaty Organization of NATO. It was interesting. There was an article on the Bloomberg this morning, just basically off-the-record discussions with leaders of the G7 saying, what was he thinking? This is terrible timing, totally unnecessary faux pas. It just seems like right now it's undermining an already fragile international order. And that seems to be sort of the moment that we're in it at G7, where suddenly Giorgia Meloni very much is at the front.
And that's where the strength is, big time. If you want to see the weakness, we can pick out a couple of things. Let's take the French-German 10-year spread right now. That's gapped out to about 75 basis points, wide of the year, the widest since 2017, which incidentally is when Macron had the presidential election many years ago. The other point of tension as well is the single name level. The banks, BNP Paribas down 13% this week. SocGen's down by 16. We're talking about some of the worst weeks for French bank stocks, going back to the US bank stress of more than a year ago.
And the question really is why? Is it because of the potential for more regulations? Is this because this is not going to necessarily be the haven in France, in Paris, that a lot of people were arguing it would be, versus, say, London and Brexit? I mean, there's a lot that kind of rhymes here in terms of some of the more populist trends. And you wonder, at what point are we talking about absolute levels, absolute populism? And at what point is it who's more populist than someone else? Who has a bigger deficit than someone else? Who's going to have a harder time raising losing money.
Who has a bigger balance sheet than someone else? Let's talk about the Japanese yen sliding after the BOJ told investors to wait until July. The BOJ surprising traders today who thought more details on bond buying cuts would be given at the meeting. Governor Ueda also pushing back against the idea that a hike is no longer possible next month. So we've got a hike kind of on the table, and at the same time what we were really looking for was clarity on the balance sheet on bond buying.
Yeah, and potentially the signaling of a rate hike now. Now people are pushing back their expectations for a September rate hike by the Bank of Japan. The fact that they're going to be buying fewer long-term JGBs really raises a question why we're not seeing more of a sell-off in the Japanese bond market. Oxford Economics coming out this morning and saying ultimately this does raise the prospect of stagflation, because what you're going to see is a much weaker yen that it seems like the Bank of Japan is willing to tolerate at the same time that growth is slowing. And that's some of the concerns that are sort of percolating.
The yen recovering just a little bit, 157, that currency pair at the moment, so just about unchanged. Earlier on, though, tons of weakness. That currency pair had gapped out to about 158, 158.26 is the high of the session. Let's wrap up the news down in D.C. Former President Donald Trump pitching tax cuts during a return trip to Washington. Trump telling Republican lawmakers he may use tariffs to help pay for income tax cuts. And according to people familiar with the discussions, Trump also floating a cut to the corporate tax rate to US CEOs in remarks just hours later. Bloomberg's Sri Natarajan joins us now for more. Sri, good morning to you.
Morning. A
long list of bank CEOs meeting with Donald Trump yesterday. Can you give us a flavour of what that meeting went like?
There is a significance and symbolism attached to the moment, right? We are exactly 2 weeks removed from the Trump verdict, when the former president was, quote-unquote, became a convicted felon. And yet, 2 weeks later, here in Washington, he has an audience of some of the most prominent business leaders in the country. That's important. Clearly, not a lot of them were out there saying we'll stage a walkout because he's there. So the verdict clearly did not impact their decision to attend it or not. Not everyone attended, but that was not because they were outraged by Trump's presence. There might have been other reasons. Now, let's look at what was discussed inside the room. Trump is out there pitching tax cuts. Remember Trump 1.0? Tax cuts were a big reason the business community loved him. Gary Cohn went into that White House, took forward that tax proposal, made sure that that was carried out. And the corporate community loved him and that administration for that particular measure. Now Trump is talking about cutting that rate further from 21% to 20%. His reasoning is it's a nice round number for the business community. Even a 1% tax rate cut is an important move. It moves the needle for sure for them.
Do you think it makes a big difference? Can you just explain for us all the difference between 21 and 20? And I said this yesterday, not 100 basis points. Just tell me the big difference for the bottom line of some of these banks.
Did you not like Trump's explanation? A nice round number. Look, a 1% tax rate could be the equivalent of what a lot of these companies are carrying out in terms of a review of their AI processes, seeing what cost savings they can extract out of their companies. That could amount to the same savings as you get from a 1% tax cut. So it is a significant number, but more importantly, it's an indication that we will be business friendly. This is an easy way to sell it, but this is sort of a key stool around which we will try and bring forth 4 more years where corporations don't have to worry about anything from the Trump administration. That's his pitch. That's important because under the Biden administration, one of the frustrations for the business community has been the regulatory pecking. It's clear in Trump's remarks, everyone's focusing on the tax cuts, but he also made a pitch for deregulation. And that you cannot underestimate or even underscore enough how important that has been, especially for the financial services community, where they have felt that you are living in an era of over-regulation, and they've been very frustrated by it. Couple that with the fact that they feel that they don't have a seat at the table with the Biden administration, that their voice is not respected enough, that automatically sends some of them gravitating towards Trump.
Are tariffs business friendly for banks?
No. It's more... Actually, let me take that back. More than tariffs being business-friendly for banks or not, what the banks and the broader business community wants is predictability. Whether there are tariffs, or you can't have tariffs one day and no tariffs the next. You can't have tariffs at this rate and a much different level the next day. And that's also important because before Trump spoke with the same group yesterday, there was the White House Chief of Staff addressing them. He talked about upholding the rule of law, maintaining U.S. reputation, but he also maintained the point of predictability. And perhaps a lot of people have forgotten that the 2016 to 2020 period, a lot of things happened. Most of those were not predictable. And the business community should be a little wary of that. And that was Jeff Zients' pitch to this group.
You started talking about how it's sort of surprising, or was surprising to some people, that a number of these CEOs went, even though there had been this conviction. It didn't seem to put them off at all. We've been talking extensively how they're essentially diplomats, modern-day diplomats, and frankly are pragmatists and care about their businesses. How much do you still see an appetite to work with and in the administration by some of the top executives at big banks, regardless of who ends up as president, at a time when a lot of people have been floating names? We've heard about Jamie Dimon, we've heard about Brian Moynihan potentially wanting to join the crowd. How much do you still hear about that?
There will be some of these names that you will never see in a Trump administration, right? At least Jamie Dimon so far has been very clear in private conversations, in public conversation, that he's not very keen on joining the Trump administration. One assumes that he will stick to it. There are a few other business leaders I can think of who would never join a Trump administration. But broadly speaking, is there appetite in the business community to go and join the administration? Yes. I mean, the same reason why Gary Cohn joined the first Trump administration. He wasn't even a Republican, but he thought he could affect change. He had a very clear agenda in mind. He knew what he wanted to accomplish. He went there, did that, spent a couple of years, or not even a couple of years, and came out of that administration. So I think that appetite doesn't go away. If you're told that you could be in an influential role where you could make the changes that you want, and it would be seen as something that will be advancing what you have practiced through your life, which is whatever enhances corporate success, you would do that.
It's one dimension missing here, and I just want to pick up on something you talked about when it came to regulation. It's not just about financial regulation. When Lisa and I have caught up with some bank CEOs over the last 6 months, one concern they have had has been about mergers and acquisitions. Their clients just don't know what deal would go through this White House and what deal wouldn't. I mean, we don't even know if we can close a deal with an entry-level luxury handbag maker. That's kind of where we're at in this country. Do we have a decent idea of how the Trump administration would be? Because one person that's on board with the Democrats and Elizabeth Warren is J.D. Vance. And J.D. Vance is in line to be the VP. Have we got any clarity on that at all?
Again, it goes back to the whole predictability idea, right? While yes, they can talk about the business-friendly practices, but it is very hard to believe that a Trump 2.0 will come in guaranteeing predictability. On January 1, 2021, if it is going to be another Trump White House, another Trump administration, I don't see a world where business leaders can sit back and rejoice and know at least the path is clear for the next 4 years for us.
Final question. If I spend $20 and get something to shake my mouse repeatedly just to keep the Bloomberg terminal on and the green dot next to my name on throughout the day, what's that about at Wells Fargo?
Don't do that, John. It's not worth it. It's a $20 hack.
What is that about?
So let's tell our audience what we're talking about. Mouse jigglers is what they're called.
Oh my God.
They became popular in the post-pandemic
I'd never heard
era.
of this. I hadn't heard of this
Me
before.
neither.
Mouse movers, mouse jigglers, as workers went back home, banks wanted to track productivity. They actually wanted to make sure that their employees were actually working. So they started tracking keyboard strokes and mouse movements, which is why technology came to the aid of a lot of workers who decided that a $20 hack on Amazon, buying a gadget like that, would actually help. It's not worked out that well. Wells Fargo, we reported yesterday, has fired a number of employees, and we continue to see more filings pop up for the same activity, this simulation of keyboard activity. It's not really clear to us whether it was still faking work from home or if this was actually happening in the office. Let's assume it was probably from home. Not a good idea, but at the same time, as bad as it sounds, I would also look at the other side of the coin. Do we really think that the best way to track productivity is making sure you're green dotted on the terminal?
Judge their output. I'm completely with you. I find this story bizarre. You either know what they're producing or you don't. And if they've been able to sit at home and just shake their mouse for 12 months, what job did they have at Wells Fargo? Okay. That's kind of what I want to know this morning.
I have a theory. When I read this story, I was thinking, okay, there are probably a couple people who had no productivity whatsoever, and their bosses said, we're going to find out whether it's the jiggler. And they went in and they saw that the mouse movement was like this, and then they went in, they raided their homes, and they found the mouse jigglers.
Oh, so FBI raid.
And then it was FBI raid, and then that was justified cause for the firing. That's what I think.
I don't know if I buy Wells Fargo's FBI-level sophistication, but let's assume some version of that. But the bigger point is, would you rather John Farrow's green dotted or he's red dotted on TV? That's when he's most productive. And that's my point about any sort of role. It's not how much time you're spending in front of the monitor and on your keyboard. It's what you ultimately produce that matters.
Is he your lobbyist?
He is. It's my agent.
Okay, good to know.
If anyone's watching, Sri Natarajan of Bloomberg. Sri, thank you. Appreciate it, mate. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Tesla investors have backed CEO Elon Musk's $56 billion pay package and his plan to move the company's headquarters to Texas. The company announced the results at its annual meeting Thursday in Austin, and this morning said that 72% of the votes cast had approved the award. The shareholder vote was seen as a referendum on Musk's leadership after slumping sales and a drop in the stock price. The Defense Department has selected SpaceX, Blue Origin, and the United Launch Alliance to compete for as much as $5.6 billion in contracts for defense launches. The Pentagon said the companies would be able to compete for contracts through June 2029, with a possible option to extend the period to another 5 years. Previously, only SpaceX and ULA were eligible to bid for national security missions. Rory McIlroy is in a strong position after the opening round of golf's U.S. Open at Pinehurst. McIlroy's first round, 65, leaves him in a tie for the lead, with a four-time major champion sharing the lead with Patrick Cantlay. World number one Scottie Scheffler shot his worst opening round of a major in 2 years to sit at 1 over par, while Tiger Woods shot a 4 over par opening round. And that's your brief, John.
Just imagine what a beautiful love story this could be. And Danny, thank you. McIlroy wins on Sunday. Wife standing there on the 18th green.
Stop.
Beautiful.
Yeah.
Right? Sort of reunite. No?
No.
Not down with that at all?
Do you actually think that this is a happy reunion?
I think this is a happy Rory McIlroy.
This is correct. This is true.
He's dialed in.
Yeah.
Focused.
Yeah.
I think he's got this
so
this
he didn't
weekend.
have a good job, and then he said, actually, come back. It's horrible.
You're not on board with this, are you, Brahma?
No,
You've got thoughts.
Okay.
I haven't got thoughts about
relationship
people's private lives.
You don't have thoughts?
No, absolutely none at all.
You have
don't
no
wanna,
thoughts?
Don't want to get involved at all. Just
Okay.
very happy
This
to
is
see.
recorded.
Very happy to see Rory happy.
Oh, I'm so glad. That's so sweet and genuine.
That's all I care about. Up next on the programme, a divided Fed starts to talk.
The fact that they are having this internal discussion and this uncertainty, I think the market should know about. It is a very tenuous period. No one knows for sure, and this kind of reflects that.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance. Four days of gains on the S&P 500 so far this week. Another record high at the close Thursday afternoon. Friday morning, we're down by 0.5%, and bonds are still rallying. We're negative 4 basis points on the session. The 10-year 420.16. Under surveillance this morning, a divided Fed begins to talk.
The fact that they are having this internal discussion and this uncertainty, I think the market should know about. It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad. On the downside, it's just a matter of when. Are we going to be there sooner or later? And okay, I know that, but I know which side the bias is on. They're going to ease eventually.
That's the consensus view for sure. Here's the latest Fed speak picking up following a week of cooler inflation data and a Fed dialing back rate cut expectations. Chicago Fed President Austin Goolsbee and Fed Governor Lisa Cook on deck, as well as Cleveland Fed President Loretta Mester sitting down with Bloomberg's Mike McKee a little bit later this afternoon. Pooja Sriram and the team over at Barclays maintaining their call for one cut this year, writing, quote, "We continue to think the cut to take place at the earliest in September. Our baseline is predicated on inflation gradually moderating in the coming months on a sequential basis and the economy gradually slowing." Pooja joins us now for more. Pooja, great to have you with us on the programme. I just want to summarise the data we've had so far this week. CPI, cooler than expected. PPI, downside surprise. Then jobless claims happened. Wrong kind of upside surprise. What did you make of the claims print yesterday, and how concerned should we all be?
Oh, thanks and good morning. I think, we really didn't take too much signal from the claims data. The fact that it did tick up for the week, I think if that trend continues, it would be in line with, some continued moderation in labor market conditions, which, really is a welcome sign. I think we should all remember labor market conditions are very strong. Whether you look at, the 3-month moving average of payroll gains or even the latest payroll report, I think some moderation is welcome, particularly from an inflation standpoint.
Geoff Yu earlier this morning from BNY said the market is more dovish than the Fed. It certainly seems that way based on the bond market rally that John was just talking about, and you could see that into some of the implied cuts. Do you think the market is wrong to be so? Or do you see that the Fed basically is trying to have a hawkish tilt just so they don't get it wrong, to reverse some of what happened at the end of last year when they indicated that they would be cutting rates?
I think, I think the markets don't necessarily price just the baseline. They've got to price, risks around that. So, the pricing is what it is. And as far as, what the Fed signaled, I think was a very balanced sort of a message. You're right. They have been burnt once, the end of last year, when there was a dovish tilt in December after a run of, weak inflation prints. And then look what happened in the first quarter of this year. So I think just, they don't want to make too much of one data point. And the totality of the data that they keep talking about, whether it's activity or labor markets, those haven't really shown a material easing. And so, what they signaled in their SEP on Wednesday was very much a tone of patience, of caution, being cautious. And they want to gain confidence that things are moving in the right direction.
What do you make then of people who say, well, if you put it all together, core PCE, which is one of the key inflation metrics that the Federal Reserve looks at, is something that is very predictable if you have the inputs of PPI and CPI and some of the other data that's already come out. People are now mapping out something akin to a 0.1% increase in core PCE, which would be very much in line with the Fed's goals, bringing year-over-year inflation to something like 2.6%. How much do you see that as actually giving a green light to the Fed as early as September, even though that's not your base case?
So, look, I think we agree with that translation. Our own forecast for core PCE in May is a 0.13%. So to your point, a very benign, very soft-looking core PCE inflation print. That said, we like to say that the Fed is not data point dependent. And it came across quite clearly in Chair Powell's press conference as well, that they didn't want to make too much of one data point. He did say that, he welcomed the May inflation outcome, and that's the step in the right direction. So, like we've written, should inflation outcomes continue to, move in the right direction, i.e. come in soft, I think that will open the door to a rate cut. But is the May PCE alone enough? Clearly not.
Pooja, some personal bias here. I have to say, I wonder how many people agree with me. I'm far more interested in how we end the year on unemployment than I am on inflation. I sense from a lot of people that come on this programme, they have far less confidence about where this labour market will be by year end than they do on how inflation's going to track. And the reason I ask this question is because the Federal Reserve has come out and said, basically, we will end the year with unemployment where it is right now. And I'm trying to work out how much confidence you have that unemployment does actually stabilise at these levels through the next 12 months plus.
It's that's a hard one to forecast. We work with the indicators that we have, and clearly we haven't seen much by the way of a move up in the unemployment rate. Of course, we were at 3.4 at some point in time. We've definitely ticked higher, but a 4.1% is clearly not something that is, weak by any standards. And I think this is a labor market that is still running strong. We look at the data as closely as we can. Of course, we're cognizant a lot of the gains are concentrated in the private sector, particularly services, particularly, education and healthcare, some from leisure and hospitality. So we've heard those arguments that the gains are all, pretty narrow. But the fact that they continue, month on month is one thing. And second is, we're looking at the JOLTS data. Job openings, sure, have come down a bit, but still quite elevated. If anything, it looks like, that momentum is still there. So, we're looking for any signs of cracks. We haven't seen so much. We're sort of with the Fed that we don't see a big spike in the unemployment rate by the end of the year.
Pooja, appreciate it. Pooja Sriram of Barclays on the unemployment rate. More on that in just a moment. Here's your lineup for the second hour of Bloomberg Surveillance. Tom Kennedy of JP Morgan, Tobin Marcus of Wolfe Research, Tasha Keeney of ARK Investment Management, and Michael Zezas of Morgan Stanley from New York City. This is Bloomberg.
The U.S. exceptionalism story probably comes through most clearly in this AI boom that we're seeing.
We can see investors moving out of cash. Again, we think to high-quality equities.
If you look at the comprehensive look at the economy, it's still relatively strong. It begs the question, why even project rate cuts at all?
The markets effectively have priced in a permanence of this higher growth, higher inflation, and higher rate world.
Where we're headed just looks like there are more positives to offset the challenges and the negatives that appear.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Can we make this 5 for 5? 4 consecutive all-time highs on the S&P 500 coming into Friday at a record. The S&P slightly negative and pulling back by 0.6%. One theme continues. It's the rally in the bond market across the curve. 2s out to 30s. The 2-year and 10-year down on the week now by about 20 basis points. There's a good reason for it. It's the data and not the dots.
And what it has to do also is U.S. exceptionalism. I keep going back to that because this is not a bond rally that's lifting all boats, quite the opposite. And I think that's interesting given the fact that a lot of people thought that the Fed would have a put on markets. Sure, maybe it's influenced the fact that people want to still buy Nvidia. Okay, sure, you can make that argument. I'd like to hear it. But ultimately, this is not lifting all boats. This is not lifting all bonds. This is in the U.S. and this is in U.S. tech.
Well, here's the argument from Neil Dutta. Bonds over stocks. Over at Renmac, this is what he says. The Fed dots will look increasingly offsides relative to the incoming inflation data. The hope is that the Fed's rhetoric shifts quickly. The risk is that it doesn't.
You know, Neil is actually onto something. And Neil, you're welcome.
You're on the same page for once.
Well, no, but I don't know. I'm not going to go that far. But I will say this. You know, he has been highlighting how this is not a good kind of trend. It might be good for the Fed to cut. But if they don't cut, he thinks they'll be making a mistake because he doesn't see a lot of this weakness as historically being linear. So typically, if you get a weakening like this, it's a lagging indicator and there's a lot more coming down the pike. I would argue that stock markets are sniffing that out because under the hood, things are looking a little weak. It's not this rip-roaring kind of excitement. Let's get to the party. Jay Powell's there with a keg. This is not the same kind of market that we were talking about, say, 6 months ago.
So I said it was the data, not the dots. That was a direct quote from Andrew Honhorst of Citi, and you built on that in the newsletter yesterday. This is what Andrew has to say about the labour market. Labour market data and survey anecdotes point to businesses trying to reduce labour costs. I want to come back to a point we discussed in the previous hour. I sense from the people we speak to, they have more confidence about where inflation's going to be by year end. But when you ask them about the labour market, that's when they're a little bit spooked by things like jobless claims yesterday. And we've had a series of head fakes on that data point. I'll repeat that. I know. But that's where they're a bit spooked. When the Federal Reserve is still forecasting unemployment year end for where it is right now, and basically only a little bit higher for year-end 2025 as well. That's where there's some real doubts, I think.
Especially given the fact the Fed chair came out and doubted their own data that came out in terms of
overstated.
Payrolls. It was possibly overstated. People said, can you make sense of the fact that these two surveys were completely different in terms of their conclusion? And he said, no, I can't. Sorry. You know, this is a reason why we're not, what is it, data point driven? We're not data point dependent. We're data dependent. Look, I think that there is a lot of confusion. Right now, in markets, it seems like there is a bigger risk on the margins tilting toward maybe we are underestimating how much weakness there is in an economy that so far has held up, but is showing some signs, I don't know, slowing down just a touch.
That's just 2024. I've got to talk about 2025. The former president on Capitol Hill talking up tax cuts, reportedly, talking about the corporate tax rate coming down from 21 to 20, talking about paying for income tax cuts with the income from tariffs, which is an interesting report we've heard in the last day or so as well.
So what actually is he going to go through with? And you asked this question earlier of Sri, which is this going to be a business-friendly Republican Party? Is this going to be a business-friendly Donald Trump? Well, tax cuts might be. Less regulation might be. Tariffs, absolutely not. Some of the increasing tensions geopolitically, fewer immigrants, given the fact that a lot of companies, we heard Marriott in particular, saying that they kind of need them in order to keep growing, especially at the pace they have been. This is a soup. And when we start talking about what's happening over in France, you have to wonder if the U.S. is 6 months behind with respect to policy uncertainty and the ultimate realization there are no plans to pay down the deficit. zero. So the question is, what kind of room is there to do additional kind of stimulus?
France teaching us once again that in Europe, deficits matter. Here are the scores right now on the S&P 500. Equity futures negative by 0.6%. In the FX market, there's your euro weakness, 106.97. Recovering just a little bit. That currency pair is down by 0.4%. On my screen at the moment, sort of tracking this, the French 10-year, German 10-year spread, gapping out to 20, or rather gapping out to 76 basis points. We were close to 20 not so long ago, Bramo. That's the week so far. That's the widest level going back to 2017.
And the gapping out that we've seen so far this week in that spread is the biggest move that we've seen going back to late 2011 during the height of the European debt crisis. There's a whiff of that underpinning some of this, just the idea that maybe there's a threat to the EU and maybe there's a threat to this idea that these nations are going to pay back their debt and be okay with that.
That misplaced sense of French superiority in the bond market getting smoked so far this
Really?
week.
First the food, then their misplaced sense of superiority, their chauvinistic nationality. What was that?
Hey,
nationalism?
that wasn't my phrase. That wasn't my phrase.
No, that wasn't.
That was the World Bank president.
That was.
Hey, don't associate that with
all
me.
right. You don't want to be a chauvinistic nationalist?
No, I'm not even sure what one is.
I don't know what it is
I don't know what he was talking
I
about.
actually really
No
want
idea.
to have him back on and say, what is chauvinistic nationalism?
That was the World Bank president with Anne-Marie, by the way, if you're just tuning in. I've never heard of chauvinistic nationalism.
I kind of like
before.
it.
Yeah,
I mean, it's
okay.
like,
Well, if it works for
having
you.
dinner, why do you want the potatoes?
I'm not sure I want to be associated with
nationalism.
that. All right, OK. Coming up, Tom Kennedy of JP Morgan Private Bank and why this is a strong economy in a fragile world. Tobin Marcus of Wolfe Research as Trump pitches lowering the corporate tax rate. And we'll catch up with ARC's Tasha Keeney as Tesla shareholders approve Elon Musk's pay package. We begin with our top story. 4 days of gains, 4 days of all-time highs. Growing optimism for Fed rate cuts this year, driving stocks higher and bond yields lower. Tom Kennedy of JP Morgan Private Bank writing the following. While our market and economic outlook is constructive, we acknowledge two main sources of uncertainty: geopolitical risk and the US election. Tom's with us for more. Tom, good morning.
Good morning.
And don't worry, some of those subjects we just discussed, we will not be throwing your way. Let's talk about US politics first of all. Why is that such a big uncertainty to you? Why does that matter so much?
I think you can look back in history and see that elections don't have lasting impacts on equity markets. But I think we'd all be forgiven if this time might be a little bit different. And you can look towards some of the things you guys are talking about here this morning. What's going to happen with fiscal deficits? I don't see either party showing any restrictions or any inclination that they will dial back in deficits. I think it's this kind of thing. We could have had this conversation last year and 2 years ago and 5 years ago. Maybe it's too bullish of a statement, but is it possible we'll sit here and do that the same next year? But in the meantime, it's just, for my clients, more interesting to talk about what can you do about it? What is in your control to handle?
What can you do about it?
I think you have to just simply look at the deficit. It's a simple process. Either revenues have to go up, taxes, or you got to cut expenses. You guys tell me, which one do you think is more likely? So for our wealthy clients, I think it's taxes go up. At some point, you got to get tax efficient. That's the easy part. And with muni ratios normalizing rates back up, that's a place to be. I think the other risk there is just around tariffs and the decoupling from China and how it's handled. I think President Biden and President Trump are actually converging a little bit with the tariff announcements from President Biden recently. But those are symbolic, right? But it is indicative of where the U.S. needs to decouple and where supply chain security is so important. EVs, batteries, national security type of infrastructure. It's going to take a lot of CapEx. Where's that CapEx going to go? U.S., Latin America, Canada with allies. So I think you can invest alongside that. I think it's a multi-year theme.
Tom, I got to say, I love speaking to you. I talk about the potential for deficit. It's, the loss of U.S. supremacy, bond yields surging, Liz Truss moment in the United States. You're like, maybe just be a little more tax efficient in your portfolio because, taxes could go up. There is this issue of whether people are overreacting at a time when we just had a 30-year auction yesterday that was incredibly strong, following a 10-year auction on Tuesday, incredibly strong. Yeah. People seem to be buying the debt at the same time that they're saying this could be a fear at some point in the near future like they have been for the past 40 years. So are you saying it's not going to affect yields?
I think the point is to acknowledge that this is a risk that's been around for a while and it's quite possible and likely that it's going to be around for a while. As a citizen, I'm just as worried as you are. It doesn't make any sense. But from a market's perspective and focusing on what our core competency is how to invest, I don't see evidence that it matters yet. Bonds are still being driven by Fed outlook with high statistical correlation. Second is the auctions are processing. And third is that global trade is still happening in dollars for the most part. I'm just giving you the checklist of things I would look for if this was becoming a risk. If it does, we have to adjust. But in the meantime, the path that you need to insulate yourself with, the most likely path is higher taxes.
This is fascinating to me. Jeff, you started the show by saying right now the market is more dovish than the Fed. And essentially, at the same time, people are looking for havens. And what are the havens? U.S. government debt, because on a relative basis, it's better than some of the other nations. And U.S. tech companies, which kind of goes to your point about increased spending on the heels of some of this broadening out. Is that the haven trade these days?
I think the haven trades are places where earnings are happening, tech companies, where I can feel confident that those businesses can exist or that spending can still happen should interest rates stay higher for longer, again in tech and the related ecosystem. And then lastly, where are these long-term trends that are just going to persist for multiple years? I think it's around AI. And for a lot of my clients, they think they have exposure. I own the big hyperscalers in AI. But I think the next leg of that is going to be in the ecosystem that's necessary for the compute power, for the land, for the infrastructure. So there's an industrial renaissance, if you will, happening in the developed world.
French stocks on sale. Let's see if we can get a bid out of you. LVMH is down by 2.6%. We've got the likes of Total having a difficult week as well. That's down 2% on the session. The likes of Airbus down by 2.5, Hermes down by 2.3. CAC 40's wiped out the gains for the year. I bring up those names and not the banks because they're really solid companies that a lot of people like. And they're getting hammered because of French politics and election happening over the next month or so. Does all of this make sense to you?
I think it's an indication of what we're talking about here, that there is deficit worries happening there and that the market will have to reprice assets without good constructive growth.
Can I jump in? Is this sort of like the euro premium is getting priced down again at a time when everyone thought that maybe it would get priced in for good reasons?
I think it's back to what Lisa's talking about. You're just going to flock to the place where you have the most confidence and safety. Now, are these good companies? Absolutely. In the long run, do I think deficits are what going to drive asset prices? No, I don't. I actually think the fundamentals and the economics will do that. Our outlook for mid-year outlook is about a strong economy happening despite these fragilities, and we focus a lot on the fragilities, but don't look to, say, a central bank like the Fed that's saying, I hear you, we're worried about the outlook too, and if the outlook worsens, we're going to cut rates a lot. I think it's the flip side of what you're saying, what you had with Pooja in the prior segment. Wow, I'm more worried about where the unemployment rate's going to be.
Yeah.
I agree. But the Fed's telling you they're going to cut rates even if the labor market stays tight. So if it weakens, they're just going to cut a lot more. There is a support network that's happening there.
So there's this sort of argument that's somewhat controversial, which is that Fed rate hikes haven't had that quick or direct impact on the U.S. economy, that a lot of the decline, the disinflation really has come from year-over-year comps and supply-demand rebalancing.
Yeah.
What's to say that rate cuts are really going to help all that much to really save the U.S. economy if we start to see a real material slowdown?
This notion that higher interest rates are constructive for an economy and that folks are saving more so that they have more disposable income to spend doesn't hold much water for me. You can see that a 5.5% cash rate, just under, is very attractive for savers in this country. Money market fund assets are accumulating very quickly. And then at the same time, rarely do folks want to borrow. So in the last 6 months, bank borrowing is up about 1%. We have seen bank borrowing that low. Historically, it's usually in a recession. So to say that interest rates don't matter, I think is kind of missing the bigger picture of what's really happening here. Durable good spending, housing spending is all down. Should you cut rates for average Americans, you're going to support their biggest asset. Crazy fact, fun fact.
Sure.
In the housing market in America, the average American has 70% home equity at this point, an all-time high. Now, prices could come down and erode some of that equity, or maybe rates come down and support that equity going forward. So I think the interest rate cuts will be quite powerful to support the economy should this bigger risk happen. But it happened at the Fed last year, and that's part of the reason I think why stocks have been so supportive.
Tom, this was great. It's good to see you. Thank you, buddy. Thank you. Thomas Kennedy of JP Morgan Private Bank. Equities just off session lows. We're down by 0.6% on the S&P. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The yen weaker this morning after the BOJ made investors wait yet another month before getting details on its plan to cut bond purchases. Some of that weakness pairing. But Mark Dowding of Blue Bay says that the BOJ can't lay out a plan and hike at the same meeting, which means a hike won't happen until September.
There's a danger. The more the BOJ gets behind the curve here, the more the danger is they're going to have to overreact and tighten policy more aggressively, say at some point in 2025.
Dowding went on to call the BOJ's decision a disappointment. He joined me this morning on Bloomberg Brief, which you can catch weekdays at 5 a.m. Eastern. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have capped credit card swipe fees. The deal, which was announced in March, would have let merchants charge consumers more for transactions involving Visa or MasterCard. Spokespeople for both firms said that they were disappointed by the developments. Wells Fargo has fired over a dozen employees last month after investigating claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work with methods like mouse jigglers taking off after the pandemic. A company spokesperson said, quote, Wells Fargo holds employees to the highest standards and does not tolerate unethical behavior. And that's your brief, John.
Danny, thank you. Is it unethical if you just want to sort of like leave the screen up? You know, you've done your work.
And then you want to jiggle the mouse?
Sure.
I mean...
Is that unethical?
Ethical?
I've done my job. Been productive.
Okay, do you think that the boss is really going to look? If you've been productive, somebody
who are you speaking
out
to?
there...
Who are you speaking to? Someone out there.
Are you going to be actually looking to see about jiggling the mouse? No,
I'm going to
it's
buy
only
one.
people.
I want to see how they work.
Really?
Yeah, I'd never heard of them before.
You're
Didn't know it was a thing.
Oh,
Didn't know it was a thing.
Really?
$20. I'm going to buy one. Gonna have it on set.
I actually want to see what it looks like.
Yeah.
I think it's noisy.
All right, we'll find out. We'll buy one. Up next on the programme, Trump's pitch for a second term.
I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
We'll have a serious conversation about policy and a less serious conversation about how awful Milwaukee might be or might not be.
What?
Oh, you didn't see those comments?
I mean, yeah, but that's
apparently they
upsetting to
happened,
me.
but then apparently they didn't happen.
Yeah.
Yeah, okay.
That's not a good look.
More on that next. Beautiful morning in New York, by the way, just fantastic. Summer really getting going. From New York, this is Bloomberg. Waking up to a tough session in Europe. France, CAC 40's down hard. We're down another 2.6%. The French banks, losses of more than 10% so far this week on the likes of SocGen and BNP Paribas. Some of that's following through to US equities. We're down by about 0.6% on the S&P. Just bear in mind that yesterday we did close at another all-time high on the S&P 500. But this bond market rally continues too. Lisa, yields are lower by 3 or 4 basis points, 420.74.
Yeah, right now people are looking at the potential for the Fed to cut sooner. You really raise the question, is this because of disinflation or is this because of the whiff of maybe some weakness in the labor market? Ultimately, that will become the question.
I think we've got to focus on the labour market a whole lot more. We'll continue to do that for you. Under surveillance this morning, Trump's pitch for a second term.
What's happening to our country is of great concern to the group of people standing alongside of me. We have great unity. We have great common sense. A lot of very smart people in this room and a lot of people that love our country. I just want to thank the Republican Senate, and I want to thank also the House. We met, as you know, with the full House, Republican House today, and we had a tremendous meeting with them also, and there's great unity.
Here's the latest. Donald Trump saying he'll lower the corporate tax rate to 20%. The former president reportedly making the comments during a meeting in Washington with around 100 US CEOs, including Jamie Dimon, Tim Cook and Jane Fraser. Tobin and Marcus of Wolfe Research writing that with a Trump win in November, the good news for markets would be front-loaded and the bad news would come later in the year. Tobin joins us now for more. Tobin, I'm not going to ask you about Milwaukee, don't worry. I'm going to ask you about policy. When you say front-loaded versus back-loaded, what kind of policies are you pointing to?
Well, first of all, Jonathan, I have nothing but good things to say about the great state of Wisconsin, so ask away. In terms of the good news that we think is front-loaded for markets, largely we're thinking about deregulation there. I think the clearest set of things that Trump is proposing to do and can do, and that the entire Republican Party is aligned on, is rolling back a quite wide swath of Biden regulations that have been proposed across sectors, but particularly in financials and the traditional energy complex. So, those are the sectors that we look at as the likeliest sort of immediate winners in the near-term aftermath of a Trump win. But then, when you look at the broader set of things he's proposing, including things that people are less certain he's going to do, like his quite aggressive tariff agenda, like some of the fallout from paying for the tax cut extensions that they want to do, which could entail Inflation Reduction Act, energy tax credit rollbacks, could potentially entail some healthcare tax cuts or healthcare cuts. All that stuff, I think, is going to develop later in the year. The tariff agenda is going to take a while to come together. That's really the sort of biggest concern. And I don't think that is a sort of day one, put that stuff into effect kind of agenda. I think that's something that they're going to be, doing investigations and threatening and negotiating and working on that through the year with tariffs not actually taking effect until late 2025 or later.
Tobin, in the discussion nationally, a lot of people think of immigration as more of a social issue, but actually a lot of the CEOs probably are very concerned about that, in part because of how much this has helped support a labor market without maybe commensurate wage increases. RBC put out a report that said if some of the proposals went through that have been floating out there, a 50% decline in immigration is possible. How much do you see as being factored in the discussions that you have with different executives, with different people in the industry, as a likelihood, not just a possibility?
Yeah, it's something that we've been talking about a lot. I certainly agree that there's been growing market focus over the course of the year into the extent to which immigration and some of the changes in Biden's policies at the border in terms of humanitarian parole has supported continued labor force growth, sort of raised the break-even number for what we can add in terms of payrolls without having really strong inflationary impact. So that's something we worry about. I think that is largely sort of the exception to the overall idea that we're arguing that the good news is kind of front-loaded, because we do think that, in the first 100 days, we'll see a pretty expansive immigration agenda. I think the thing that is most concerning that Trump can certainly do is end the humanitarian parole programs Biden's put in place that account for about 75,000 entries into the U.S. per month on a kind of quasi-legal basis, folks who are eligible for work authorization within a month after that. So that's a very direct flow into the labor force that we think shuts off right away. The broader swath of things, including some of the policies that are going to be most concerning to corporate leaders in terms of, H-1B visas and high-skilled immigration, I think some of that stuff is more subject to litigation. And, throughout the first Trump term, there were this huge amounts of litigation over what he was attempting to do on immigration. I think we'll see that this time around also. I think we'll see a lot of proposals in the first 100 days. But other than this parole piece, I think a lot of that is going to end up tied up in courts for quite a while. And so certainly some of the most concerning stuff in terms of the promises that they're making around internal enforcement, deportation, trying to round up millions of people and deport them, that I think will prove quite operationally challenging in addition to the kind of legalities on that piece.
Tobin, I just wanted to jump in and finish on the deficit if we can. In Europe, there's a conversation that takes place that doesn't often happen in the United States. People come up with a proposal, and then places like the UK will say, well, how is it funded? How are you going to pay for it? France is going to have the same experience based on what's happening in their bond market over the last week or so. In the United States, they've always had this privilege of behaving recklessly. They don't have to worry too much about that. Something interesting, I think, happened in the news in the last 24 hours. Reportedly, the president suggested kind of the corporate tax rate, 21 to 20, talked about making the 2017 tax cut permanent, talked about exempting tips and earnings from federal taxes as well. So we understand all of that. But he also said something interesting. He talked about how to pay for it, which I think is pretty new. He talked about maybe using tariffs and the income from tariffs to do that. Can you give us an idea of how much money you could raise for ramping up tariffs on US imports?
Yeah, absolutely. And I think for markets, this is a lot of what we are worried about for around the fiscal debate next year. We're talking about extending $4 trillion worth of expiring tax cuts on the individual and pass-through side. Most of that sort of high income, marginal tax cuts is not going to be particularly relevant to markets, but we think the conversation about how to pay for it is very relevant. We do think that there need to be some offsets. I don't think that's going to be fully offset, but I think even in unified Republican governance, they probably need to get that $4 trillion down closer to 2%. I will say that Trump's floating a 20% corporate rate, I think at some level is a recognition of the challenge that they're going to have fiscally on this. Like he's talked about lower numbers in the past. A 1 percentage point cut is not particularly impressive. I think that's a way of saying, like, I want to get it directionally lower, but I know that it's going to be challenging paying for all this.
Interesting.
You know, the tariffs on a static basis, both the two big pieces of Trump's tariff policy, the 60% tariff on Chinese imports and the 10% tariff on global imports, could each raise about $2 trillion.
Tobin, I got to go. Tobin Marcus of Wolfe Research. Equity futures on the S&P 500 negative by 0.5%. On the Nasdaq 100, we're down about 0.25%. The Russell struggling. We're down by 1.2%. That struggle is happening even with the screen looking like this. Turn the page and switch up the board and get to the bond market. The 2 years rallying. Yields are lower. We're down by 4 basis points on a 10-year. 420, 16, and the small caps not getting a bite at all this morning.
I love that you point out the fact that the Russell 2000 isn't getting any love this morning, despite the rally in bond market. There was a discussion for a long time about how the first Fed rate cut would be an absolute rallying cry to go to the small caps since they were so leveraged. It's not the case. And you have to ask why. And I think you've answered it by really saying we need to focus more on the labor market to really understand just how fragile, what's behind some of the disinflation that we've seen.
If I was going to walk away from this week with one takeaway from the news conference with Chairman Powell, it would be that he thought that payrolls was overstating the strength of the US economy. Now, to what degree, to what extent, he can share that himself. But we've all got a view on that. And then to see claims pop out to 9-month highs just gets you a little bit more focused on what really matters here. And I think ultimately it's the labour market.
Which is the reason why you're not seeing a broadening out. And that's the reason why the rally is still dominated by big tech that's thought of as really the safe haven in the equity market. To me, that's significant because this is getting more fragile in terms of the rally. It's held up by fewer prongs. And at what point can that continue? Well, maybe indefinitely, but are we really looking at an economy that's saying U.S. exceptional comes with exceptionally strong growth? Maybe it's U.S. exceptionalism because everyone else is flat on their backs.
And this is why we like the FX market, because it's a relative game. So take a look at the euro. 109 last week, 107 this morning, 107.03. And briefly, in the 106s. And you can thank this spread right here. The French-German 10-year spread gapping out to 76 basis points, the wide of the year and the widest since 2017. The new concern, so we have a new one. It's the parties on the left forming some kind of alliance, making it even more confusing as to what is going to happen in these elections the next month or so.
But looking more likely that Emmanuel Macron is not going to get a majority like he was hoping for. A lot of people shaking their heads about the timing of this because it's coming not only during the G7 or right ahead of the G7 where leaders have already been weakened, but ahead of a NATO meeting that's going to be really important given some of the focus on Ukraine. All of this just reminds everyone this is not necessarily a world where the U.S. really can decline against so many other people. And, you know, we're talking to Tom Kennedy, and I said to him after our hit, I said, so basically you're seeing the dollar really strengthen. Yeah. What else is going to really counter it? And that's what we're looking at right now.
Well, Europe's struggling to counter it. I want to point out the banks as well. We're down 16% on SocGen this week. 16%. We're down something like 13% on BNP Paribas. French banks have had a really difficult week so far this week.
We should bring Jay Pulaski in. He needs a rallying cry.
He's got thoughts on Europe.
He
right?
does. He's all in on the European banks, right? Jay, call in and tell us what you think and why they are going to come rip-roaring back when everyone realizes you should not leave them for dead and that one election isn't going to necessarily shake the confidence
Jay's hiding somewhere with a tin hat this morning, pretending that that's not happening on the screen. Under surveillance this morning, President Biden's international charm offensive continuing at the G7 in Italy. Biden meeting with the Pope and Italian Prime Minister Giorgia Meloni today. The meeting's coming after he signed a new security agreement with Ukraine. At the same time, the former president is making headlines on this side of the Atlantic on what he may or may not do in the next 12 months.
Domestically, which I think has been a distinction we've been talking about. This is about foreign relations. The domestic issues are the ones that are going to get people's attention. And really, you're right to keep bringing up, okay, we're hearing these proposals. What does this do for the deficit? What does this do for the ability to spend? What does this do to the U.S.'s relation? You're talking about tariffs and the potential for increasing tariffs to pay for any income tax cuts that the former President Trump just proposed. Could you even create a model for that? I mean, you don't even understand what the retaliation is going to look like, let alone what kind of trade's going to get through. How
You're assuming that the imports remain consistent as well, right? And people just don't back away from those imports if they get too expensive. But there is a tell here. And I know there's always a risk in trying to read the tea leaves around reporting around the former president. But I think there is a bit of a tell here. The fact that the former president reportedly is aware enough that you need to focus on this as an issue going into November tells you everything you need to know about November. The days, I'm not going to say that the days where America can behave recklessly with its deficit are over, but I think we're getting close to the point. I know this is sort of like stating the obvious, but we're getting close to the point where that is over. It's coming to an end. And you can hear that in the way that these leaders are talking about what they want to do in the future.
I agree with you. The fact that the deficit is a campaign issue is a throwback to the past. And that in and of itself says a lot. The fact that they try to give nod to the deficit, but then give absolutely no way of paying it back gives you a sense of where we are.
Which is why the deficit's an issue still.
Correct.
Let's get to the yen sliding as the BOJ tells investors to wait until July for details on bond buying cuts many thought would come today. Governor Ueda also saying the BOJ could hike interest rates in July depending on the economic data. We did gap out to about 158 on dollar yen. We're back down to about 157.21. Talk about being dazed and confused around the Federal Reserve. You're more dazed and confused around the BOJ going into next month.
I mean, everyone was kind of expecting them to signal a more near-term move than, say, September, which is now what people are talking about. It's a likely move, the likely rate hike from the Bank of Japan. I just wonder what the pushback's like domestically. They're keeping the yen weak. There are some concerns about stagflation. Do people welcome the tourists? Not really. We've heard a lot of pushback. I mean, maybe it's good for the economy, but other than that, not great. And it raises the prospect of a bad kind of inflation. So it's kind of head-scratching why they're not more concerned and looking for moves, I'm talking about the Bank of Japan, that could offset some of that weakening that a lot of the intervention just hasn't seemed to stave off.
Well, when you started talking about foreign exchange and tourists, I was looking at the euro earlier this morning at 106 and thinking something similar.
Yeah.
Perfect timing.
Yeah, that's
Just going
exactly how I
into the
feel.
summer. I know, just right.
I want to talk to resorts in the U.S. who are losing customers to Europe.
Real thing you said earlier this week.
I actually think that's interesting and sort of how they're trying to lure them back. Is it like French night?
Let's get to Tesla. French night at a US resort. OK. Tesla shareholders voting to approve Elon Musk's $56 billion pay package and greenlight the company's move to Texas, the stock having a pretty decent 24 hours. Tasha, Keeney of ARC, constructive on the name, writing this. Our confidence in Tesla's ability to launch a robo-taxi network within the next 5 years has increased considerably. I'm pleased to say that we can catch up the Tesla bull right now. Tasha, great to catch up with you. I just want to start with the shareholder votes of the last day or so. Of course, they've been going on for a number of days. Do you think we can leave this issue in the past now and move on?
Well, I'm not a legal expert. So, of course, we know what investors want. And now it could be up to the courts again. But what I'll say is that I think it's positive that, we saw investors considering the proxy and putting their own votes in, voting for themselves. When we look at Tesla, we certainly want Elon Musk to be at the helm, especially when you consider the transition to fully autonomous driving, which is what we think will drive the majority of the value of the company over the next 5 years.
Can you walk us through why and why you think that's the real deal and we'll see it that quickly over the next 5 years?
Yes, well, so we already have robo-taxis, right? Waymo, which is Alphabet's autonomous driving project, is driving around Phoenix. They're, starting an effort in LA. They're in San Francisco, but we don't have them at scale yet. Tesla could be one of the first companies to offer a service like this at scale, and it's because they have a massive data advantage. They're collecting information from customer cars that helps them train their models, and they have more cars on the road than any other autonomous effort that I know of in the U.S. And this is their plan. They're layering on software updates incrementally. Right now, it's the full self-driving software that's available to customers. Eventually, customers will be able to take their hands off the wheel. And then last night, we heard Elon Musk talk about extensively the robotaxi effort, where you as a customer could sign your car up when you're not using it. But more likely, I think it'll be a fleet model. So you'll have perhaps another company that owns and maintains the fleet. Tesla collects a take rate off of the per mile revenue. And, I think this could have very attractive margins, higher margins than the current business model today, which is mainly selling vehicles, right? And this will be a recurring revenue. So again, we think very attractive from an economic perspective to Tesla. But more importantly, it'll change all of our lives. I think this is one of the greatest AI projects in our time. And we are so lucky that we get to witness it.
Tasha, there's some real questions about Elon Musk's leadership and whether he is focused enough on Tesla and diverting some of the chips that have honestly reportedly gone to some of his other companies to really get some of the robotaxi efforts fully underway. Why do you think that's not a concern?
I actually think it's a positive that Elon Musk runs a number of companies. One, we've heard them talk about this. It's great for talent acquisition. We've seen employees move in between his companies. If you're the top AI engineer in the world, you're not going to get bored working for Elon Musk. The chip story, what I'd point out is, automakers actually often negotiate on behalf of their suppliers, and they do so because of economies of scale. They have better negotiating leverage. So I think having, all of these companies that, many of which might use NVIDIA products is, again, actually a positive here. And we've also seen manufacturing innovations come from SpaceX that bleed into Tesla. And I think you have to look at the Tesla results here, right? When you're talking about the pay package, the stock has risen over 1,000% over that time period.
Yeah.
So he's really delivered shareholder value. And I'm, again, so excited for the future because we're really on the cusp of autonomous driving today.
Tasha, is there absolutely anything that could happen that is a potential event in the next year that could shake your confidence right now in Tesla?
Well, really what I'm looking for is for Tesla to cross that threshold into fully autonomous driving. We've seen them tease this robotaxi service or a ride-hail service, both on the past earnings call and at the event last night. So I'm looking for that launch. So we have an event coming up in August from Tesla that's going to look at the purpose-built robotaxi, the next generation car. I don't think they need that car to necessarily launch the service because their current fleet is capable of it. But I am looking for details at that event about what this business model will look like. We heard some of that last night, so we know that they're thinking through the back-end logistics of how this will work. So I think that they could cross this threshold within the next year or two, and that is the catalyst that I'm most looking forward to with Tesla.
$2,600 price target, which is pretty punchy, as you know, and certainly gets attention. That's for sure. Can you tell me the biggest risk factor associated with your call? What would change your mind?
Well, certainly I think that solving autonomous driving is a very difficult problem. It's hard to time that exactly. But again, as you mentioned, in our blog, which is on the ARK Invest website, we think that this could happen in the next 5 years. And our confidence has increased with all the advances in AI and Tesla's, improvements that they've rolled out to customers that actually own the vehicles and the software. That is a risk. Again, we're confident that they can do it, but it is a difficult problem to solve. I think, what gives us confidence from last night is, if this pay package gets totally approved, we know that Elon Musk is going to be at the helm of this company for at least 5 more years. He has limits on when he can exercise his options. So I think that is another key piece that we want Elon Musk to stay. We want him to be incentivized. So I think that's ultimately a good thing.
Who do you think controls the fate of this call? Do you think it is Tesla and their ability to execute, or do you think it is the regulator, local authorities, who will ultimately have the decision to make to give this the green light or not?
Great question. I was just going to touch on that. So often people are concerned about regulation. I actually think that, again, the more difficult problem here is actually making the technology work and scaling this type of service. The U.S. has actually been surprisingly lenient with autonomous driving because it's been up to the states. And we've seen, Tesla right now, they have over 1 billion miles cumulatively in the full self-driving software suite driven. So I think that they'll be able to statistically prove to regulators that this is safer than humans. And actually, we've done some research on this. So if you look at their full self-driving software suite, the last time they gave us a statistic, which is a little over a year ago now, it looked like it was 5 times safer than human-driven Teslas, and even safer than the average car on the road. So we're already seeing those proof points, and I think it could get even better. And in fact, Elon Musk has hinted that they have line of sight to maybe a 4x improvement on that, and that's what's going to matter to regulators here. So we're already seeing those safety points.
Tasha Keeney, great to catch up with you. Thank you. Tasha Keeney there of ARK Investment Management. Bramo, you know how this works. You can go through the stats and make the case that the technology is safer than a human being behind the steering wheel. Unfortunately, what happens when you have that one single fatal accident It's the front page of the newspaper, and it sets everything back a long time.
Yeah, people like to think that even if they can be distracted or look at their phones or texts or have an extra beer, that they are somehow better off than a robot that has a better track record but occasionally can malfunction, which is the reason why we've seen a whole host of different trials banned, particularly in the southwest of the United States.
It's quite a big call. In fact, it's a massive call coming from Mark on that particular name. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Luxury labels are discounting their products like never before in China. Concerns are growing over unsold inventory while locals have pulled back on their spending. Starting this month, Chinese shoppers can snap up a small beige crocodile pattern version of Balenciaga's iconic hourglass handbag for 35% off. Other labels are doing something similar. Versace, Givenchy, and Burberry have all slashed prices, some by more than half on Tmall and other domestic platforms. Microsoft is withdrawing a new AI feature on its Windows software for new PCs. The feature, known as Recall, creates a record of everything people do on their computers. Microsoft now says it will only be available in the Windows Insider program instead of all new computers. Researchers had criticized Recall almost immediately after it was introduced, saying that bad actors could access records that are gathered by the tool and stored locally on a user's PC. The FAA is investigating counterfeit titanium that was used for parts for Boeing and Airbus aircrafts. A report from the New York Times says the material was sold using falsified documentation that claimed to verify the material's authenticity. Those claims came from aircraft manufacturer Spirit Aerosystems. The investigation was launched after small holes were found in the material. As of now, it's unclear how many planes have parts made with the material in question. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, it's the data, not the dots.
Inflation, which we're all focused on, has eased considerably. I certainly expect further progress to be made, especially as rents and other critical price pressures recede over time.
Don't know about these cosy fireside chats, you know.
It looked like hard-hitting.
I prefer just have it. It's a bias. I have a preference for it to be sort of like a journalist who has real hard-pressing questions to try and hold them to account.
It's what's the goal here? We could discuss.
Yeah, okay.
You put yourself up. Raise your hand for it.
Yeah, I'm not sure they want that to happen. But anyway.
I would.
Right. I know you would. From New York City this morning. It's beautiful outside. It's just fantastic. Let's wrap up this week and go home. Equity futures staging just a little bit of a recovery this morning. We were down by about 7 or 0.8%. We're negative by about 0.4% on the S&P 500. In the bond market, the rally continues. It's a break of 420. It's 4.1997. Yields are down by 4 basis points on a US 10-year. In the FX market, the euro weaker. It's a break of 107 this morning, 106.98. We're negative by 1/3%. The concerns about France still there, very much front and centre when it comes to the European story. Under surveillance this morning, it's the data, not the dots.
Inflation, which we're all focused on, has eased considerably. Headline inflation is down almost 2/3 from its peak, and core inflation has also trended down on balance, and I certainly expect further progress to be made, especially as rents and other critical price pressures recede over time.
Here's the latest. Treasury yields falling as cooling inflation data boosts optimism the Fed will be able to cut rates later this year. Michael Zezas of Morgan Stanley writing this. Our economists still see 3 cuts this year. The CPI number helped. We still see Treasury yields trending lower towards 4% into year end. Michael joins us now for more. Michael, good morning to you.
Good morning.
Inflation soft this week. Shouldn't that be the big takeaway? Downside surprises, CPI, PPI, is it that? Or is it jobless claims at 9 months high? Did that spook you at all?
No, not particularly. I think you're right. Like, inflation should be the focus. And I think much credit to the Morgan Stanley economists, who I think have been very consistent on this all year. There's a lot of noise in the data early in the year. They still had a lot of confidence that inflation would be coming down. We're starting to see that very much in the data. And it's all consistent with the idea that we're going to get a cut. We think we're going to get a cut in September, 2 more on the follow after that. And then that should keep Treasury yields moving lower. That should drive a lot of confidence for fixed income investors overall.
That word confidence, I want to play with that just a little bit more.
Yeah.
there's a lot of people that are talking to us at the moment that don't have much confidence in the forecast for unemployment over at the Federal Reserve. What's interesting about that is that actually we used to call their forecast aspirational, and they actually materialised in a very, very favourable way. So it's not to say that it can't happen, just how probable is it that we end with unemployment at the end of this year where it is right now?
Well, I think it's more likely you see it tick up, right? And that's consistent with our economics forecast. But there's a lot kind of undergirding that number, right, in terms of the size of labor force. Obviously, we've seen the size of labor force go up quite a bit with immigration numbers. But as long as inflation is coming down, again, then I think the broader narrative for fixed income investors is going to be, we feel more confident that the next move from the Fed isn't rates higher, or is probably going to be rates lower. And whether or not it's 1 cut, 3 cuts, but we think it's going to be 3 cuts this year, total return tailwinds are pretty substantial in that environment. And it's not even just about government bonds. We really like actually corporate credit in that environment as a way. You're cutting not because the economy is weak, you're cutting because you're getting from restrictive territory to neutral territory. That should be solid for credit fundamentals because the economic backdrop is good. So even though you've got tight spreads, you can earn that extra spread and get even better total returns.
I can get all that. I can understand the logic, and I'm sympathetic to it. But then other people will say by the end of the year, there are going to be other issues as well. And you wear a couple hats at Morgan Stanley. One of them is professional deficit warrior. And I am curious about how much that starts to really factor in to really counteract some of that 4% call on benchmark yields.
Yeah. Well, I think the deficit story, or the real potential delta in deficits, probably more a 2026 story, or at least a late 2025 story. And that's because the main conduit for deficit expansion or contraction is whether or not the provisions inside of the Tax Cuts and Jobs Act, which are all expiring at the end of 2025, whether or not those get extended. A lot of that's going to be a function of the election outcome. Now, we think it's kind of pretty base case, even with investors, we talk about that there's going to be an extension of a lot of those provisions, so it shouldn't be surprising that the deficit will look higher than what the government is projecting right now. But again, that's something that comes into play 12 months from now, after we've collected a lot of other economic data that's going to interact with markets.
So just to sort of sum up what we're seeing right now in markets and a lot of the conversations we're having today, it's sort of like U.S. exceptionalism is being reinforced by dysfunction in France. I mean, is that essentially what we're seeing, that all of the worries are sort of, put to bed by everybody else being a lot worse? And so basically we're looking at a scenario where the U.S. will be just fine?
I mean, I don't know that I would go that far, right? I do think that we've got a broad story where the economic fundamentals look good, right? The growth story is pretty good. Inflation is coming down. And we've got a major political variable of our own to deal with, which is the U.S. election at the end of this year. And that could change the perception in terms of the economic trajectory in 2025. But beyond that, the story through the end of the year, which is a more reliable one, is kind of the internals of the economy are broadly supportive of the fixed income market.
Need your thoughts on the tax proposals that have been floated in the last 24 hours. I know it's all sort of like in newspapers and reports, and it's difficult to sit there as an analyst and put some numbers together. But if the former president came out and said, you know what, I think we can fund some of these income tax cuts with tariffs and the revenue from tariffs, how would you be thinking about the numbers around that issue?
Well, listen, some of the third-party estimates here are that if you do a broad 10% tariff, you get something like $350 billion of revenue. But that's making a very big assumption that the actual price level of imports wouldn't change, which I think most economists would tell you is a bad assumption to make, right? So you don't know how much money you would actually generate from that. Could you use it as an offset? So in a situation where Republicans win the presidency and they're looking to extend most provisions of the TCJA, I think in the court of public opinion, they'll probably make the argument that there's some offset there. When we actually look at what it does to the deficit on an official score basis, it's probably going to be less of an offset. So the way we have it sized up, Republican outcome scenarios, particularly a Republican sweep, probably lead to bigger deficit outcomes in 2026 and beyond. And the more you skew towards a Democratic sweep, the smaller the deficit increase. But we have deficit increases across the board marked in no matter what the election outcome is.
It seems to be the takeaway. If you get one sweep, doesn't matter the colour. not great for fixed income.
Well, but this is the thing. When won't it be great for fixed income, right? Not yet. It'll be fine. Maybe 2026.
Getting closer.
We are.
To that moment.
I just hear Steve
I don't know when
Eisman
that
in my
moment
head.
is.
Like,
Or the deficit.
The deficit.
Yeah.
You've been doing it for 30 years. I mean, it's true, except how much, again, is U.S. exceptionalism being kept alive by French fragility?
See it in the FX market this week, that's for sure. Michael, thank you.
Thanks
Michael
so much.
Zezas of Morgan Stanley. Coming up, Darrell Cronk of Wells Fargo, PG&E CEO Patti Poppe, Eugenio Aleman of Raymond James, Zach Griffiths of CreditSights from New York. This is Bloomberg.
The theme is still patience, and the Fed just wants to see more data to make sure that inflation is convincingly moving lower.
There's no clear indication that they're going to need to rush into cuts.
They're trying to tell us that they're keeping all optionality open. Even if there was a shift in the pace to get there, it seems like their direction of travel is still towards a rate cutting cycle.
It is a very tenuous period. No one knows for sure. And this kind of reflects that. And I don't think that's necessarily bad.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Did you ever play like the odd one out as a kid? Is that like a game you played? You had to like spot the odd one out?
Like,
you'd line up a list of things. You had to spot the odd one out.
Sorry, we
Okay,
called
so
it something a little bit different.
What did you call it?
We called it, well, it was just like pictures, like two pictures,
Sure.
and you had to figure out what was missing.
Okay.
What was different.
All right, so like thoughtful conversation, sophisticated market-based version of that. I'll read through some headlines and then you can say, you know, which one doesn't make sense here. So headline 1, jobless claims rose to the highest level in 9 months. Okay. Number 2, PPI delivered the biggest decline so far this year.
Yeah.
Number 3, CPI stepped down for a second month in May. Number 4, the Fed reduced the median dot from 3 cuts to 1. Which one stands out for you?
Okay. This is like the financial version of an SAT. Why would the Fed cut their expectations for how much they're going to reduce rates if you see disinflation, potential weakness in the labor market, et cetera? A lot of people are saying, is that correct?
I'm just saying something doesn't add up here.
Okay.
And that's the piece of it that doesn't add up.
Except that you look at what happened at the end of last year and the sort of conditioned by experience and the fact that in the first quarter of this year, there was hotter inflation than many people expected. But I get your point. We seem to be at a tipping point, which is the reason why markets are in a very different place than the Fed seems to be and are looking past the hawkish tone and saying, you guys are just kidding us.
I'm going to keep going back to Neil Dutta, your friend over at Renmac.
Hi, Neil.
The Fed dots will look increasingly offside relative to the incoming inflation data. The hope is that the Fed's rhetoric shifts quickly. The risk is that it doesn't.
At this point, though, it seems like the market is moving with or without the Fed, because right now the Fed has no edge, and it's unclear exactly what's going to tip the balance. What I find interesting in this week's market move is that it is not unabated strength. It is not an unabated cheer rising up through Wall Street saying, if the Fed cuts rate, this is going to be a rip-roaring rally that ignites another wave of this recovery. This is something different, with an underperformance of a lot of the consumer-facing sectors and an outperformance of a lot of the winners to date. So it doesn't seem like this market is rallying against a sign of strength and Fed saviors. This is a market rallying around the idea that, yeah, the winners can keep winning, but the losers aren't going to win that much in a time of great uncertainty.
You've got your finger on the pulse for sure, because I don't sense the hubris this week at all. It's not one of those weeks where you have 4 consecutive days of all-time highs and everyone's punching the table, banging things and going buy, buy, buy. I think there's a real asterisk there this week, even with the encouraging inflation data we've had over the last couple of days.
If you take a look at where the performance is, equal weight on the S&P is down. If you take a look at the NASDAQ 100, it's up. You can see more broadly that the market-weighted S&P is up something like 1.6%. Why? We had a couple of big tech names that reported they were winning from AI. That drove a lot of the gains yesterday. You look under the hood, small caps underperforming yet again. These all indicate a more greater sensitivity to what you've been pointing out, John, which is a weakness in the labor market, which is a Jay Powell that came out and said, perhaps what we saw last Friday overstated just how strong this U.S. labor market is.
More on that in just a moment. Equity futures, your scores right now, negative by 0.5% in the bond market. The rally continues, which speaks to some of the themes that Lisa was kind of laying out there. Yield to lower by another 5 basis points. Your 10-year, a break of 420, 419.58. Lisa also pointing out that Europe is spending a lot of time making everyone else look good. And we're seeing that in the FX market with the euro at 106.91.
Well, I happen to wonder if today is basically U.S. exceptionalism by default, because there's nobody better. And we've been talking about that extensively, and people can worry all they want about the deficit. But then you look over to France and you say, what a mess. I mean, what level of mess do you want? Whether it's, the additional threats to Emmanuel Macron, whether it's some of the deficit concerns, et cetera. All of a sudden, boop, you got that dollar strength again, and everybody's going to Europe for vacation. So, this is some of what where we're at this morning.
Everyone's going to Europe.
Everyone around this table. Just want to make that point.
I know.
There you go.
I know. It's like there or Tokyo, with the euro at 106.90 and dollar yen still very close to 160. Coming up this hour, here's your lineup. We'll catch up with Darrell Cronk of Wells Fargo with stocks on track for 5 straight days of gains. We'll catch up with the PG&E CEO, Poppe, on the impact of EVs and AI on the electric grid, and Zach Griffiths of CreditSights on why he sees a notable economic slowdown in the second half. We begin with our top story. Stocks on track for a 5th straight day of gains following a week of softer than expected inflation data. Darrell Cronk of Wells Fargo saying the following. As the S&P 500 makes news highs, it's important for investors to rebalance to avoid portfolio equity concentration risk. Trim tech and communication services to neutral weightings. Darrell joins us for more. Darrell, good morning to you.
Good morning, John.
What did you make of that opening exchange? Are you with us?
I'm with you 100%. I mean, so everybody knows the concentrated returns. I just ran the numbers yesterday. If you look at just the top 5 names, right, not the top 10, top 5, they're driving about 82% of the index, 13 to 14% year-to-date return. So strip that out, you're up maybe 2-3% year-to-date on the broad, level. But maybe what's more important is when you look at those names, the top 5, 10 names, the correlations are as high as they've been since August of 1997. Right? So what's that tell you? It tells you that people are chasing, right? They're chasing those winners and continuing to feed into it. And to Lisa's very good point, if you take the NASDAQ 100 against the Russell 2000, so tech against small cap, 5-year wides, right? I mean, we're at the widest level we've been. So, small cap continues to underperform, not surprisingly. I keep getting asked every conference room I go into, every meeting, when's it time to buy small cap? When's it time to buy small cap? And I keep saying, not yet, not yet, not yet, right?
When is the time?
The Russell 2 probably needs to be somewhere in the 1800s, maybe even 1700s before I think you get a compelling risk-reward flip there that makes sense, but nowhere here above 2000.
So why do you have this argument that you should be more concerned about concentration, since that's one, and more interested in some of the others that keep lagging behind?
I think because eventually you end up with this kind of, think of it almost like it's a Teflon market, right? Nothing seems to stick to it. Every risk that we roll at it, right? Whether it's, the France risks this morning and the tails or anything like that, just seems to bounce off of it, and the same theme plays through. AI wins, tech wins, right? It's 7 months into that. If you run a marathon or a race and you sprint for 7 months, which we have sprinted, let's be honest about it, you're going to be tired. And I think the market is tired here. It's, when you look at those top concentrated names, to the point they're doing extraordinarily well, right? And I'll take it. But I get under the surface, right, whether you're pointing equal weighted, small cap, I look at some of the other sectors, they're just not participating at the same level.
So I guess the question is, do you sell your big tech exposure or do you buy everything else? It's a big distinction. Are you bullish on the other sectors, or are you just simply getting a little bit more skeptical of how much further tech can run?
So yes to the former, right? Which is, so I think when you get underneath it, we just released our mid-year outlook this week, right? One of the things we did in the mid-year outlook was took energy to the most favorable we could possibly take it to, right? In the portfolios. Basically, we ran it up to the highs. Big pullback, obviously, in oil prices. We've taken all the political risk premium out of oil prices, which kind of shocks me given the global landscape of where we are. I'm getting a lot of big, whether it's the integrated energy names or even some of the exploration companies at 12, 13, 14 times PEs with a 3.5% dividend. I will take that all day long. We also like materials. We think healthcare is a good value play here. And we would fade places like, the consumer, obviously REITs, and even financials look a little bit overbought to us here.
Wait, consumers, REITs, and financials. This is very interesting at a time where the Fed ostensibly is going to be cutting rates pretty soon.
Correct.
And at one point, this was supposed to fuel the next consumer spending wave in the sense of consumer strength and ability to borrow in a new way. Why is it not playing out that way?
Because I'm not sure the consumer is as strong as people want to give it credit for, right? I mean, if everybody does including us, the top 5 quintiles of income, right? We know that the bifurcation of the high end is doing well, the low end is not. But what people are missing is kind of the creep up into the middle income levels of where people are trading down for value. They're not spending as robustly as they want to. You see, consumer confidence numbers are still in a downtrend. Small business numbers are still, pretty ugly, right, when you get below the surface. So there's just not a lot of reason to believe, to us it looks like the consumer's kind of running that last mile here, right? They've been able to stay durable and spend. I'm just not sure how much gas is left in the tank, Lisa.
So this time last week, when we read out the payrolls number of 272,000, you didn't hear 272,000. You heard something else?
I think payrolls and the labor market in general are getting skewed heavily by some of the lag effects of what's happening with immigration in this country and everything else. So we ran the numbers again. If you take just immigration from pre-COVID levels, we're 3.3 million people higher today in the labor force than we were coming into 2020, if you will. That's having real impacts on the labor force, right? And those numbers. So the labor market is still strong. We'll take a 4% unemployment rate all day long, but I'm not sure that it's as strong as maybe the numbers might be sending a little false echoes there to us.
This is what Chairman Powell basically said in the news conference. One of my sort of biggest takeaways from the polls over the last year is this poll right here. It's from Guardian Harris poll that came out in the last month or so. And it reads as follows. I'll give you some headlines. It's stunning. 55% believe the economy is shrinking. 56% think the US is experiencing a recession. 49% believe that unemployment is at a 50-year high.
Wow.
49%. That's the poll that came from Guardian Harris in the last month or so.
It's the reason why consumer sentiment has been so low. People don't feel good. Is that wrong? Can you say that people's feelings are wrong, or are they feeling something that the numbers aren't showing in quite the same level? And people explain it by the K-shaped recovery. Stay tuned for the University of Michigan Sentiment Survey out in approximately 1 hour and 49 minutes.
Or maybe we're just not measuring things properly.
Correct.
Household survey versus establishment survey last week was the big standout, Darrell.
I think you're spot on, right? I mean, I think you've got to really, you can't just take those headline numbers as they stand, right? You've got to dig in under the surface and kind of take the second derivative, third derivative, and understand what those numbers are telling you. I am a big, firm believer that liquidity is masking so many things around the economic element. I mean, we just went back and ran the numbers from just the 2020s, we're now in 2024, obviously. Financial markets are up about $46 trillion in AUM, right? Government debt is up $12 trillion, right? Think of just the liquidity that pushes into the engine, right? And the ability for consumers to stay longer, right? For businesses to feel better, right? All of that has had this kind of long-lasting, call it the marathon effect, right? We run hard for 7 months, but Wall Street isn't Main Street, right? And so the S&P isn't what people are feeling if you walk up and down Main Street to the point of the survey, right?
49% believe the S&P is down for the year. This is quite a poll, isn't it? It's amazing.
Yeah, that is amazing.
A lot of the companies are down, so it also speaks to the non-AI members.
Darrell, this was great. It's good to see you, sir. Thanks
too.
for sharing your thoughts. Darrell Cronk there of Wells Fargo. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's get to Danny Berger. Hey, Danny.
Hey, John. A check on Adobe this morning. Shares up 14.33% in the pre-market. They projected strong sales for its suite of creative products, and that suggests that customers are adopting Adobe's new AI-based tools. They've been integrating AI into some of their most popular products. That includes things like Photoshop. The CEO said that it's helping the company attract a, quote, expanding universe of users. A judge looks set to reject a $30 billion settlement between Visa, MasterCard, and retailers, which would have capped credit card fees. The deal, which was announced in March, would have let merchants charge consumers more for transactions involving Visa or MasterCard. Spokespeople for both firms say that they were disappointed by the developments. And Germany will meet Scotland in the opening match of the European Football Championships in Munich later today. The hosts will go into the tournament as one of the favorites alongside England and France. Defending champions Italy face a tough task of winning the tournament again. They're in the so-called group of death with top rivals Spain and Croatia. Only 2 teams from each group advance to the knockout rounds. And that's your brief, John.
Danny, thank you. Try not to talk too much about that. going into the weekend.
Yeah.
Good luck to everyone participating.
Happy weekend.
Happy weekend
Yes.
and all of that.
Yeah, that was basically for you.
Might be going on a
Control you.
vacation,
Yeah,
which sort of
exactly.
coincides with
Are you
3
going to
games.
any games?
Coincides with 3 games
going
that.
to them?
No, I'm not. But I'm going to try and watch them. You know how that's going to work, don't
Yeah,
you?
yeah,
Sort
I
of
do.
at the dinner table,
Yeah,
sort of
good luck.
streaming them. And
Oh, that's going to be
looking at the
great. That's
scores.
really going to go well with the
Gonna work out.
fam.
Yeah, all right. Up next on the programme, the morning calls and the PG&E CEO, Patti Poppe, joining us next from New York City. This is Bloomberg. Equities on the S&P 500 negative by 0.5% following 4 days of all-time highs, record after record for the whole of this week. Looking to make it 5 for 5. It's going to be a struggle, Bramo, based on this screen. We've got equities softer, we've got bonds rallying, yields are lower by 5 basis points, 419 on 10s.
And how much is this sympathy with what's going on over in Europe? And how much is this a realization of what Darrell Cronk was just saying, which is the internals look a little weak and the consumer maybe on a back foot a little bit more?
Euro weaker, breaking down to 106 today, 109 last week. French 10-year versus the German 10-year. An update on that, 77 basis points. Getting a little bit wider on the session again. Time now for some morning calls. First up, Evercore upgrading Shopify to outperform. The analyst expecting better profitability longer term and saying this is an attractive entry point on the stock. Next up, KBW upgrading Bank of America to outperform with a price target of 46. The upgrade backed by a higher forecast for net interest income. That stock is down about 1%. And finally, JP Morgan upgrading Adobe to overweight. The firm's seeing better growth in the second half of the year and new products with artificial intelligence. Of course, the rise in AI services also driving demand for electricity. Growing computing power and the rise of EVs have traders looking for ways to invest in the energy grid. I'm pleased to say that joining us now is Patti Poppe of PG&E, joining us around the table. Patti, good morning to you.
Good morning, John. Great to be with you.
Fantastic to catch up with you. We're going to see massive demand, potentially. EVs, data centres. Can you help frame that for us? How big is this going to be over the next few years?
Yeah, we forecast, and in fact, we shared with investors here in New York this week, a doubling of demand between now and 2040. That's a CAGR of about 4% year over year. And we think that's a great opportunity because we see ways of serving that load while reducing costs for all customers on the grid.
That's a big challenge. So help us understand how you're going to meet that challenge.
Yeah, so our grid today is underutilized. We actually, the utilization factor of the grid today is about 45%. We see that growing to 60, 70, 80% even. And so imagine more fully utilizing existing assets lowers the unit cost. That's what happens in every other business but energy. We've built the grid big. We built it big decades ago. Now we get to utilize it and make it smarter. So with modern computing, we can actually optimize how we utilize resources on the grid and use them more efficiently.
So utilities have been sort of the hotbed. It's basically been the way for people to go into AI in a new way to represent some of the power usage that's going to be necessary. I know the PG&E has lagged behind a little bit of the broader rally that we've seen in utilities. What are you telling shareholders in terms of how you're going to close that gap? What sort of pieces you're going to really lean on to catch up?
Yeah, what we share with investors is that we are on track on our turnaround. PG&E has been through some very difficult times in the last decade, and we have put the company on a new and solid footing. Over the last 4 years, we have implemented a safety and financial safety, both physical and financial safety framework for the company that has now given investors confidence to come back in. So we have both the benefit of the new demand and closing our discount all at the same time, which makes us both one of the growthiest utilities and the ability to reap some of the benefits of our turnaround.
What will be the contours of the utility companies that benefit most from the AI boom? I know that you talked to the likes of Apple, you talked to all of the California tech companies. They're in your state after all, but there's really a question of what it takes to win.
Yeah, we're proud to serve Silicon Valley. We serve the Bay Area of California. We serve Northern and Central California. So all of those great tech companies are our customers. And so we're very tightly knitted with them and helping deliver on their demands. We think that we can serve their load with mainly transmission and distribution. There will be some new generation added, but the utilities who win are those that own and operate transmission and distribution systems where there is data center demand and EV demand. It might surprise you that in Santa Clara County specifically, 43% of new vehicles sold last year were electric. That's flexible demand, the first form of flexible demand on the grid. The lights come on when it's dark. Air conditioning comes on when it's hot. EVs can charge any time. We send the right price signal. We've got excess power in the middle of the day because we have distributed solar. We can fill, as I say, the belly of the duck with EV demand, and that costs nothing. That is utilization of existing assets to the benefit of all customers, not just that EV driver, but all customers on the grid get a lower unit cost of energy.
Someone told me recently that California had the second most expensive power rates in the United States. Can you help me understand why that's the case?
Yeah, rates are a reflection of how much energy you use. We all have a grid that has to be built for a peak day. So if you have a grid, and like ours in California, doesn't get stressed but a handful of days a year versus a Southwest or a Southeast utility where they have heat every day, we have to build the grid for that peak day. That's why EVs and dynamic demand are such a benefit, especially for PG&E customers, because we have an underutilized grid. That drives a rate up, but their actual average bill is not nearly as high as much of the country.
Could we talk a little bit about power plants as well? How easy is it to build and connect new power plants in places like California?
Well, it depends what you think of when you say power plant. In California, we think of clean energy. So last year, in the California Independent System Operator Zone, we added 9 gigawatts of new power supply. That surprises people. 9 gigawatts added in California last year. That serves 9 million customers. That 9 gigawatts was mainly renewables matched with storage. Storage is the game changer. In fact, April 16th, storage was the #1 resource utilized in California. Again, matched with solar. We have great solar penetration. Matched with storage. That's a new kind of energy supply. 100% of the energy that PG&E delivered to our customers last year was carbon-free. We have a modern energy system in California, and PCG is so proud to serve California, where I think it's the golden era of energy for all energy providers, but particularly in the Golden State, and we get to power the Golden State, and we're proud of that.
How much time are you spending in Washington, D.C., and how much do Washington, D.C. policies really change the way you approach some of this in terms of what the different potential subsidies are for green energy or not, and also where solar panels are coming from and how much they cost, given that a majority of them are produced in China?
Yeah, I don't spend much time in Washington, D.C.
Lucky you.
I wear boots. I wear boots and a hard hat. I had to do my hair special for today to be with you. Listen, I'm boots on the ground with my team. We are building the grid of the future, and a lot of that, it depends on us. We have a saying, performance is power. When we perform and as we perform at PG&E, we can deliver the power that people need.
But to that point, how much is your business model challenged depending on what comes out of, say, tariffs on solar panels that you will need to deploy for some of these energy purposes?
Yeah, because our grid, again, is underutilized, we have a lot of the resources we need. What we need to use them smarter. So I need to be with my tech companies because we're building a digital grid. We're building resources that are technical, that are small bets, not big bet asset deployments, but leveraging the grid and serving customers in a much more dynamic way. It's a smarter, faster, more affordable grid, and we don't need much help from out of state to do that.
Patti, this was fantastic. Fantastic to see you in person without the hard hat.
Yeah,
right,
anytime, John, I'll come back.
You can bring it. It's okay.
Okay, good. Next time I'm wearing it.
I think that would be nice.
There's some people in financial markets wearing tin hats at the moment, but that's a very different reference. Patti Poppe there, the PG&E CEO. That's a very Lisa Abramowitz thing to do.
What?
To wear a tin hat in financial markets, yeah.
I think that I should show up one day with a hard hat. It's like, today's going to be rough.
I'll send you one, Lisa.
Thank you. I appreciate that.
Today's today.
Big
Coming
boots.
up very shortly, Donald Trump promising to lower the corporate tax rate by 20%. Or to 20% from 21% if he gets a second term in office. That conversation just around the corner. Equity futures on the S&P 500, negative by 0.4% on the S&P. In the bond market, the rally continues. Yields are lower by 5 basis points. The 10-year, Lisa, about 4.19 here. The rally continues.
It's just amazing to see, despite some of the deficit worries, despite the idea of longer-term inflation going up, still very much front and center, the possibility of the Fed cutting rates and a weakening in the U.S. economy.
That conversation just around the corner, and we'll catch up with Anne-Marie on the ground in the south of Italy as we wrap up the G7. From New York, this is Bloomberg. The most feedback I've had so far this morning. Good luck to everyone. This is football, John. I don't believe you mean that for a second.
100%.
Just don't want the tension about football going into the weekend.
Really?
People start arguing about it. I just don't need that in my life
People.
anymore.
What are you talking about, people?
You know, like everyone.
Yeah.
It's a very international program, so people have got their own countries and...
Yeah, no one's buying it.
You know,
I'm sorry, no one's
if you
buying
notice,
it.
the most diplomatic person I know is Mohammed Al-Arian.
Yes, he
okay,
is.
if you notice what Mohammed does with sports, he'll be like, congratulations to everyone who participated. Every single time.
Yeah.
Every single time.
Yeah, and then I get the messages, come on, why did the Mets suck? We're both Mets fans, so there you go.
Mets and Jets, which I've always found is like the loser combination when it comes to New York sports. What is that about? Why is it always Mets and Jets? Why is it always the two combined?
I don't know, because I'm actually more of like a Mets and Giants fan, so I don't really understand. Maybe it's just that there's like a feeling of virtue in following a losing team.
Got it. Okay. Never really understood that, but all right. Equity futures on the S&P negative by 0.4%. We're 1 hour away from that opening bell. We're down by 0.2 on the Nasdaq 100. We've had quite a run of gains in the equity market. 4 days of gains, 4 record highs. 4 consecutive all-time highs on the S&P. Looking to do some more a little bit later, but at the moment it's a struggle. On a Russell, the small caps down by 1.2%. That move, even with this move in the bond market, 2-year, 10-year, 30-year, stacking up as follows. Here are the scores. 466.43. We're down 3 basis points on a 2-year, down another 4 on a 10-year. We had a brief break of 420 a little bit earlier in the session. 420.54 is where we are, Lisa, right now on the 10-year.
And you really raised the point. At what point do we start talking much more about the labor market and just how strong it really is at a time when the Fed might not be having any dovish speak? The market's saying, we don't believe you. We are looking at other things, and they are pointing to some sort of not only disinflation, but also a slowdown. And that's really where the focus is this week.
I've always said, you know, smartest audience on the planet, and I'm super privileged to have it. Mets and Jets played at the same stadium from the 1960s to the 80s, according to David, who just writes in. David, thank you.
David, thank you.
Apparently that's the story.
And David, thank you for correcting my completely butchering the whole thing with making up some reason.
You know, it could be another dimension to it.
Yeah, sure.
Yeah, all right, whatever. Let's get to the euro.
Thanks, please.
Let's focus on
talk
foreign
euro.
exchange, something we might know something about. 106.84, it's a breakdown of the single currency. We're down 0.5%. That's one touch point. Here's another. I want to talk about the French 10-year versus the German 10-year, briefly as wide as 77 basis points. Why does that matter? Bit of perspective, some context. 77 is the widest we've seen not only this year, but going all the way back to 2017. And from there, then you start thinking about going all the way back to the real tension of 2011, 2012.
So, you know, just to put it into perspective, it's the pace of move, too. The pace of the expansion that we have seen in terms of the spread, the gap between OATs, French bonds, bond yields, and German bond yields, has been the fastest going back to that time frame, to that 2011 European debt crisis. So one thing that Geoff Yu this morning, and I just really keep going back to that conversation, he said, keep looking at the potential to widen out more and what that signifies about the fragility of a region that at one point provided a counterpoint to the dollar and increasingly maybe less so.
The banks are picking up on that tension. We've got SocGen down on the week by something like 13%. We've got BNP Paribas down a similar amount. In fact, SocGen on my screen at the moment on the week is down 16.5%, which is a pretty rough week. That would be the biggest weekly loss on that particular name on the CAC 40. Biggest weekly loss going back to March 23, which is when we had real tension in the banking system this side of the Atlantic.
We should explore at some point just exactly why they are so vulnerable to some of the potential shifts in the government. Because is this just a deficit call? Is it a bond call in terms of valuations shifting? Or is this an issue of potential regulatory uncertainty given some of the threats about the euro region and what this could do?
You know, I joked earlier on this morning about the false sense of superiority in the French bond market.
Was that a joke?
Yeah, no, I think there's some truth to the fact that they've been grouped in with Germany for a long time. And there's real questions as to why. There was a budget deficit to GDP last year of 5.5%. You know, are they closely aligned with Germany or more closely aligned with what's been developing in Italy? And I think you could make the argument, and things could change, of course, that Giorgia Meloni's government right now in Italy is more stable than Emmanuel Macron's in France, that's for sure.
Yeah, which is the reason why you're seeing the spread widen and the reason why people could say it would go further. Arguably, this move began when the France government rating was downgraded
because that put them on risk to not be able to pay back their deficit. And that potentially could lead to this sort of existential fear that France is not Germany and that actually credit risk does matter once again.
Deficits matter in places like France, the UK, and keep coming back to this point. Will they matter here in the United States? Under surveillance this morning, a couple of stories for you. Bloomberg reporting meme stock investor Keith Gill, better known as Roaring Kitty, is exiting his entire options position in GameStop. A screenshot of his E-Trade portfolio no longer includes the calls set to expire next week. Roaring Kitty's cash position dipping to $6.3 million from nearly $30 million on Monday. Lisa, quick stock check. We are up by about 2% in the pre-market.
So he's moving out of his options. However, he has increased his stake in GameStop, his actual cash stake in shares, to become one of the biggest investors in this name, in GameStop. He is up there. There are only 3 other investors who own more than 9 million shares of GameStop as he does. That include BlackRock, Vanguard, and RC Ventures. So it sort of raises this question of just what his influence is going to be and what will Roaring Kitty do next?
Still waiting to see. Have we ever seen Vlad Tenev and Keith Gill in the same room? Has it ever happened?
You're going to start this rumor, really?
They look identical.
You think that's going to happen?
I'm not the only one saying that.
Okay.
They look identical.
Do you want to make some of the conspiracy theory?
Person. No, no conspiracy theories.
Well,
I had a really weird conspiracy theory yesterday that I'll talk about another time.
Yeah, not on air.
Something like that. Yeah, not on air. Let's get to this one. A New York judge is likely to strike down a $30 billion settlement between Visa, MasterCard and retailers. The deal would let merchants charge consumers extra in payments using Visa or MasterCard credit cards. The note coming in a court filing yesterday. An official ruling is expected in the coming days. Remember, there was all this talk about maybe retailers charging more depending on which credit card you were going to use when you paid for all your items.
So is the issue here, and this is sort of what's yet to be determined, is the issue that the fees have to be bigger? Is it that they have to charge lower fees? Is it that the convenience stores can't pass it along to the consumer? Is it that it ultimately has to be a business model thing? I mean, this raises a lot of questions about how to remedy this and whether this is more friendly to some of the charge cards or whether this is more friendly to the retailers. I read a number of different articles and couldn't get a sense of what the answer was.
I had the same questions as well. And another thing that we've brought up earlier on this morning is how different things are going to be under a different administration around issues like this. Of course, this goes through the courts and this can continue going through the courts. But I mean more about mergers and acquisitions, business-friendly regulation, who are we fighting for, the small guy or big business, and what's that's going to look like if we do have a change of administration in the next 12 months?
You raised J.D. Vance. He's been for a lot of the antitrust efforts. So it's really a black box. Good luck for 2025.
Yeah, flying blind to 25 is like the catchphrase of this programme at the moment. Here's the latest on the 2025 effort. This from the former President Donald Trump returning to Washington, floating tax cuts to lawmakers and business leaders. Trump telling CEOs he would cut the corporate tax rate to 20% from 21%. Trump also on Capitol Hill saying he would like to extend income tax cuts and use tariffs to help pay for them. Joining us now to discuss is Eugenio Aleman of Raymond James and Zach Griffiths of CreditSights. Zach, I want to come to you first. We've learned in the UK that deficits matter with Liz Truss. We're learning at the moment in France that deficits matter for Emmanuel Macron. How quickly before we learn that deficits matter for this bond market in the US?
We don't think it's that soon, John, and the dollar has the privilege of being the world's reserve currency, and so I think that's a big driver. Now, if we do get a red wave, let's say at the end of this year, and some of these more expansionary fiscal policies that could lead to larger deficits and higher inflation, I think that changes the calculus a bit in terms of, do deficits matter? Are we going to see it priced in? Are yields going to retest the highs of last year? So we are circling the election as a key litmus test to how much that comes into market pricing over, let's say, the next 12 months. But our base case is we have a little bit more wiggle room in the U.S. than in other nations.
Eugenio, we keep saying that we're flying blind into 2025. How much clarity, visibility do you have on next year? Never mind 24.
Oh, nothing. Nothing. I don't see anything going forward. But I want to say hi to Zach. We were together at Wells Fargo. And it's very, very difficult. As you were talking before, there's a lot of signs that are pointing to a slowdown in economic activity. So the decision by the Fed was, I think, that an overkill. because, I mean, they raised inflation to 2.6% this year from 2.4%. So 20 basis point difference between March and today. But at the same time, they took away 50 basis point decline in interest rates. So in real terms, if we are correct with inflation continuing to coming down, that means that they are tightening monetary policy because the real federal funds rate is going to continue to go higher.
Zach, we keep talking this morning about how the response in markets has been very interesting to not only concerns about the deficit, but concerns about the Fed being a bit hawkish, or if cutting rates, why that isn't just an unmitigating positive. And I've got to say, from your vantage point, given all the concerns swirling, where are you focusing in markets to understand what the risk appetite is at a time where lower yields are supposed to help risk assets? I mean, what you saw yesterday were high-yield bond spreads widening at one of the fastest paces this year.
It's an interesting point, Lisa. When we look at what we're seeing in the market today, and something that I feel like we haven't seen in a long time, is your traditional risk-off move where you have equities falling and government bond yields rallying. That's not a relationship we've observed recently. So to the extent that we see more of that, perhaps some of these geopolitical pressures, of which there has been plenty over the past even couple years, yet there's been a very calm market backdrop, I'd say that would signal to us that perhaps there is a shift in risk appetite. And during the client meetings we've done more recently, I don't think there's a lot of concerns necessarily about the U.S. economy going into recession, perhaps too few concerns. But at the same time, we are hearing more caution in the way portfolio managers are positioning. So it does seem like there's a little bit of caution around just how much markets could be priced to perfection, as the Fed has seemingly taken additional rate hikes off the table, but they've also reduced the amount of rate cuts they expect in the near term. So from our perspective, we are looking for a consumer slowdown. And I think Eugenio makes a great point about their adjustments to inflation and expectations for the nominal policy rate. We don't think we're in an environment where they need to be tightening the real policy rate. And so we are more dovish than the market, and we are more concerned about a modest repricing of credit risk in terms of spreads across investment grade and high yield.
And before we get back to Eugenio, Zach, I'm curious from your perspective, that type of repricing of risk, does that include a repricing of U.S. risk? Because that's what we're seeing right now in places like France. Or is that just simply credit risk at a time where still the U.S. has exceptionalism simply by default?
That's an important distinction, Lisa. We prefer duration risk over credit risk. So we'd say not a wholesale repricing of U.S. risk in terms of Treasury yields. So yes, we prefer being overweight duration relative to overweight credit when we look at the balance of the level of yields and the tightness of spreads even today.
Eugenio, what do you make of that? This idea that there is perhaps a little bit more caution under the hood than perhaps some people are realizing, and maybe markets are just sort of sniffing out at a time where it does seem like the economy is just beginning to soften, maybe even a bit more than some expect.
Yeah, I typically disagree with markets, but I think that markets are correct in pricing 2 rate cuts for this year. On the fiscal issue, I am not that concerned with the U.S. So, I mean, we were looking at numbers from France the other day when their risk rating was changed. And tax revenues as a percentage of GDP in France is 46%, vis-a-vis the U.S., which is 18%. For us to get out of these issues with the growth in debt is very easy. I mean, some analysts, some economists are saying that a 2 percentage point either increase in taxes or decrease in expenditures, or a combination of both, will stabilize the growth of the debt. So the reason why I don't think that we are exceptional. I think that the real differences between what could be done in France to bring down or to pay back versus what we have to do here is very, very different. I think that our social contract is broken. We no longer agree on how to do it. But if we can do it, if the political system can do it, then it will be very, very easy.
Gentlemen, I was very happy to be a part of the Wells Fargo reunion. Invite me next time. This was fantastic. Zach, I do have a question for you. Zach, before you go, I've got to ask, was it a thing to jiggle the mouse at Wells Fargo? Is that a thing? Is that what people were buying? Do you have any insight on that?
I never saw it, never saw anything like it in the corporate investment bank. I don't know what could have been going on in other parts of the business. So I didn't see it, John.
Great to get some insight. Thank you, Zach. Zach Griffiths of CreditSights, alongside Eugenio, Aleman of Raymond James. There you go. Just getting some, some real-time reporting batters, Lisa, on one of the most read stories on the Bloomberg terminal.
I did some real-time reporting.
Sure, what do you got?
looked at the reviews on mouse jigglers on Amazon.com, and there are people who put their name on mouse jigglers. And I'm thinking to myself, why would you do that? Because there's only one reason to use a mouse jiggler or a finger jiggler or whatever it is that's going to be on your thing. But people put their names down. Very effective.
I've got an idea. What we should do. It'd be a
what's that?
Great story. Fantastic. You should apply for a job. Okay.
Anywhere else but here, is that what you're saying?
Any job. No, remote work. Remote work. Apply for the job. Go through the interview process. See if it will get cleared from management. See if you get said job. Hopefully you'll pass the interview test. We'll do some work together. I'll do some tests with you. Then when you get the job, you buy one of the mouse things, and we'll see how long you last in the job. But never do any work. See how long you last.
This is a great experiment.
Right.
Let's get right on that.
You're always online.
Rachel,
okay.
I'm on it. Please.
Always online.
I expect approval.
It'll be a very cool story. See how much you can get away with working from home.
I bet we could get away with a lot.
And then we'll donate the income to charity.
Really?
Yeah.
Okay.
It's a great plan. All right. Let's get you an update on real news elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The FAA is investigating counterfeit titanium that was used in parts for Boeing and Airbus planes. It's from a report from the New York Times, and it says that the material was sold using falsified documents. Those claims came from aircraft manufacturer Spirit Aerosystems. The investigation was launched after small holes were found in the material. As of now, it's unclear how many planes have parts made with the questionable material. Let's get back to that story you were just talking about. The details here. You mentioned the mouse jigglers. Well, it is Wells Fargo firing over a dozen employees last month. The investigations led them to claims that they were faking work. A review found that they were simulating keyboard activity, creating an impression of active work. A company spokesperson said, quote, Wells Fargo holds employees to the highest standards and does not tolerate unethical behavior. Now, the newest franchise in the NHL has been given a name, even if it's only temporary. Utah Hockey Club is the name, and they will take the ice in Salt Lake City starting this fall. Team owner Ryan Smith unveiled the team's name, logo, and uniforms, which are black and white jerseys with a little bit of blue that say Utah across it, and little else. A fan vote for the official name and mascot is still ongoing. Those in contention include Mammoth, Yeti, Outlaws, Venom, and keeping it simply as the Utah Hockey Club. That's your brief, John.
Danny, thanks for this morning and for the week. Just on sport, I've had so many messages on Mets Jets.
I know. I've got a lot of corrections as well.
Thank you, David. Thank you, Gerard. Thank you, Stetson.
Thank you, Mark.
Mark, the list goes
on and on.
On and on. Up next on the programme, we'll set you up for the day ahead, going into the week ahead, and we'll catch up with Anne-Marie on the ground at the G7 to give us the latest from Italy. All of that up next. Counting it down to the opening bell, about 40 minutes away. Equities negative on the session. We're down by about 0.5%. Bit softer today, but on the week, much firmer. 4 days of gains on the S&P. Decent week of gains. Best week in about a month on the S&P 500. In the bond market, this rally just keeps continuing. Having a bit of a breather in the last 10 minutes or so, but we had a break at 420 early this morning. Back up to about 421.32 on a 10-year, down 3 basis points on the session. But it's this story in Europe I think we're all focused on. This was the surprise of last weekend, how Emmanuel Macron responded to the EU elections, the called snap elections domestically. This is a big issue for France now. You've got the French equity market getting hammered, erasing all of the gains for 2024. You've got this French-German 10-year spread blowing out to the wides that we have not seen since 2017. And you've got the single currency with some real weakness in the FX market.
You underscored one of the most important points of the week, which is essentially, even as you see a flight to quality in U.S. Treasuries, you see the opposite in a lot of European bonds. And the flows verify that. Essentially, you see huge flows into U.S. government bond markets, about $6.5 billion. And you have the biggest outflow You had fourth largest weekly outflow in the last 5 years from European government bonds. So it gives you a sense of that divergence and pretty much cold relief.
Quality. What is quality in Europe right now? And there's a question mark over French debt at the moment. Here's the trading diary for you for the rest of today and into next week. At 10 a.m., we'll get the UMich consumer sentiment data. Last big data point for you going into the weekend. At 11:30 Eastern Time, President Biden meeting with Pope Francis. Monday, Fed President Patrick Harker speaking. Tuesday, retail sales plus a host of Fed speak. Tons of it over the next week or so. Look out for that. Thursday, another round of jobless claims, and we'll find out if this week was a head fake or not. That's going to be a big data point for us next Thursday morning. Joining us now to wrap up a G7 is Bloomberg's Anne-Marie in the south of Italy. AMH, we've been talking about the domestic difficulties that the sitting president is having in the United States, that Emmanuel Macron is having in France. Just summarise what you've taken away from the meetings this week.
Well, Jonathan, they were able to get over the finish line some of these deliverables when it comes to supporting Ukraine. Today, there's going to be a focus on going after China, its economic clout, anti-dumping issues. But all of this has been overshadowed, and some of this has really played out into the forefront of these discussions, the domestic issues these leaders are facing at home, most notably when it comes to Emmanuel Macron. You have Meloni talking to local press saying that he's using this forum for electioneering purposes. Rishi Sunak has found it very hard to get a date at this G7, to have an official bilateral on the agenda with a G7 leader, because they all know that in 3 weeks' time, he is likely not going to be leading that country. And then as well as Olaf Scholz, who's dealing with really poor poll numbers and a strong showing from the far right after the European parliamentary elections. So you see this gap in what electorates want the officials to deal with and what they came to the G7 to discuss. And I asked the World Bank president about this, and has it been difficult, this really attack on multinationalism when you see a rise in nationalism? And he talked about how it's chauvinistic. Take a listen.
One of the biggest things that worries me is chauvinistic nationalism, because it tends to create the absence of connectivity. But I think if you look at the last few months itself, we've managed to get capital and hybrid capital and portfolio guarantees into our institution, and we are the one that's working with this multilateralism.
That capital going into the global south and places like Africa is a point that the United States wants to counter China, but also individuals like the Prime Minister of Italy, Giorgia Meloni, to try to stem the flow of migration they are seeing from the continent.
Anne-Marie, as you suffer on the southern coast of Italy there, I'm just curious, can you explain to us what's chauvinistic nationalism?
I think what the point he was trying to make was that people thinking that this nationalistic approach, that only their country matters and their issues matter, I think what the World Bank president was trying to get at is the fact that he thinks it's short-sighted, because when you look at putting capital to work in places that are in need, like Africa with food security, energy security, actually it could benefit individuals at home when they're dealing with things like growing migration, because people from some parts of the global south are suffering for things like trying to get a job. I did also ask him about what potentially Trump 2.0 would mean, because this World Bank has also wanted to take a look at not just countries that are in poverty, but also making sure they're focusing on things like climate change. And would that kind of approach be difficult with the Trump presidency? And he was quick to say that it was under Trump's first term that they saw a capital injection. So he's not concerned and thinks that, the World Bank will continue with the U.S. support, whether or not it's going to be Biden or Trump 2.0.
AMH, we've got 30 seconds. What's on the menu today?
Well, the menu for me is certainly going to be a gluten-free orecchiette and gelato. We'll have to see what the leaders are going to eat this evening. Biden did not attend the dinner last night, but tonight is the big G7 dinner. He will attend, and then he's wheels up. He's not going to be going to the peace forum on Ukraine in Switzerland. Instead, Biden is in full-on campaign mode. He's going to Los Angeles at a campaign fundraiser, and he'll be with the likes of George Clooney, Jimmy Kimmel, and those celebrities.
This is the important stuff, Bramo, the menu. I mean, I'm looking forward to this. I'll be away next week. Wake up, cappuccino.
Really?
Cornetto alla crema. Inzupare. You get it and you dip it in.
Okay, I'm back on strike. I'm not going to talk for the rest of the show. I'm done. This is ridiculous.
Fantastic.
All of you just basically
AMH,
mocking
fantastic work. I'll see you in Italy in the next week or so.
Aren't jiggling.
She's staying there. She's not coming back, you know.
Oh, yeah?
Yeah. She's going to
jiggle her mouse?
Just jiggle the mouse on set.
Hopefully that
That's good. From New York City, have a fantastic weekend. This was Bloomberg Surveillance.